Morning, everyone.
Good morning.
Good morning, Irving. Good morning, Michael.
Good morning, Navid.
So it's good to know the sound is working. Thank you.
Yes.
Good morning.
Good morning, Caroline.
Hello. Good morning, everyone. Good evening, good afternoon, good morning. My name is Caroline Lombardo with the International Tax and Development Cooperation Branch. It's my pleasure today to introduce the Director of our Financing for Sustainable Development Office here at the United Nations, Mr. Naveed Hanif, who will give welcome remarks to this webinar. Over to you, please, Mr. Hanif.
Thank you, Ms. Lombardo. And thank you, distinguished participants and speakers, and good morning, good evening, good afternoon. On behalf of the Department of Economic and Social Affairs, I welcome you to this UN webinar on the transfer pricing aspects of financial transactions. We are responding to calls from developing countries to provide expert advice on these issues. And this we will achieve by introducing the UN's guidance on this topic and share practical views and insights from our panelists. By the end of today's webinar, we hope that you will have not only better understanding of the challenges of financial transactions, such as the lack of comparables and the treatment of implicit group support, but also practical insights on how to deal with these challenges. Many developing country representatives have identified financial transactions as a hot topic. That is why the UN Committee of Experts on International Cooperation in Tax Matters and its subcommittee on transfer pricing started developing guidance on this topic. The guidance will form part of the update of the United Nations Practical Manual on transfer pricing for developing countries. The third edition of the manual will be published next month, culminating 4 years of dedicated work by the committee and its subcommittee. Distinguished participants, the 2021 manual offers new guidance on cost contribution arrangements and an updated chapter on dispute resolution mechanism, as well as the new dedicated guidance on financial transactions that we share today. The guidance focuses on intercompany loans and guarantees that are the two most frequently used types of financial transactions. It gives insight into scrutinizing the characteristics of a financial transaction, the process and system of credit rating, potential transfer pricing methods, and use of simplification measures and safe harbors. In doing so, the transfer pricing manual offers special insights, taking into account the different situations of developing countries. Financial transactions in the form of intercompany loans and guarantees are a normal part of how companies operate and can have a significant influence on a taxpayer's transfer pricing position. Moreover, as money is fungible, financial transactions are a simple mechanism for a multinational enterprise to shift debt to group companies in order to claim an interest deduction. Such shifting of debt will reduce taxable profits in the jurisdiction of the borrower. Depending on the situation of the group, lender, and the tax rates in the two jurisdictions, it can also reduce the MNE group's overall tax liability. That would mean a reduction in countries' tax revenues and ultimately their ability to finance sustainable development. We are privileged to have renowned transfer pricing experts with us today from international organizations, governments, civil society, and the private sector. And these include some members of the UN Tax Committee and its subcommittee on transfer pricing. We look forward to an open dialogue among our speakers and with our audience, and encourage all of you to ask questions during presentations and during the Q&A session. We also request you to please give open and honest feedback after the webinar on how these UN webinars can help you in your efforts to find solutions to tax and transfer pricing challenges. We will make a short survey available immediately after the conclusion of the webinar. Finally, I would like to thank the Norwegian Agency for Development Cooperation, NORAD, for its support. This webinar comes to you as part of a UNDESA multi-donor project to strengthen support to the UN Tax Committee, its subcommittees, and related capacity development work. We believe that by focusing on nurturing capacity of developing countries to detect and circumvent profit shifting through financial transactions, countries will be able to weather short-term fiscal shocks and build resilience, which will ultimately aid and help in financing the 2030 Agenda and their national sustainable development goals. I would like to thank the UNDESA team led by Ms. Caroline Lombardo for organizing this series. Thank you, and I wish you a productive webinar today. Back to you, Caroline.
Thank you so much, Naveed. Thank you for those inspiring remarks. I would like to hand over now, please, to Mr. Michael Leonard, the Secretary of the Tax Committee and the Chief of our International Tax Cooperation Unit. Michael will likewise have some welcome remarks and some housekeeping notes for all of us today. Over to you, please, Mike.
Thank you, Caroline. Thank you, Naveed. This is a very important webinar for us, for those who are involved in the transfer pricing work. We'll give thanks to those at the end of the webinar who've been involved in this webinar. But it's especially important because, as you've heard, it was born out of calls from developing countries for further UN guidance in this area, and that came through our capacity development work. And then this will in turn feed into our capacity development work. Secondly, it shows how the UN transfer pricing guidance works. It is consistent, for example, with the very good OECD guidance in this area, but it also has its own examples, its own explorations, and it is relentlessly focused on the realities for developing countries, the risks for developing countries, and the priorities for developing countries. An extra reason why your input, your comments on this webinar and on the UN work is very important. And thirdly, it's very important because we're lucky to have as panelists, among two sets of really top-level panelists, the two people who've really led the transfer pricing work over the last 4 years, Ingela Wilfors and Stig Solon. So it's very good to hear their perspectives on the work that they've so ably led over the last 4 years. On some of the housekeeping issues, we've got 740 registrations today, more than 60% from administrations and ministries. This webinar is being recorded. It's available on YouTube, and we'll make the recording available to you afterwards. It's only in English for technical reasons. There's no translation. Perhaps in the future we'll be able to have more translated webinars. Your screen name should have your country or affiliation. And if you have a question for the panelists, then if that's not already in your screen name, then if you could make clear which country you're coming from, particularly on questions and answers, we'll try to answer as many as possible, but we will give special attention to those from developing countries. As I've mentioned, use the question and answer function for those questions, and we'll answer them as to the extent we can. There will be 2 sessions today. The first session is on the nature of the new UN guidance, the new chapter on the transfer pricing manual, which, as you've heard, is basically complete and will be published electronically next month. And the second is exploring some of the perspectives of those from business sectors and others, and how the relevance of that issue and the relevance of that work going forward from other perspectives. As I mentioned, we'll thank everyone involved later, and the panelists as well. But for the moment, what I'll do is I'll pass over to my colleague Farid, who will introduce himself, and then he'll introduce the first panelist. Thank you, Farid.
Good morning, good afternoon, good evening to everyone. Thank you very much, Michael. My name is Farid Hasnawi. I'm Inter-Regional Advisor on International Tax Matter at United Nations. And it's my pleasure today to facilitate this session of this webinar. In this session, we will have an overview of the new chapter on financial transaction of the UN Manual on Transfer Pricing. Then we will hear some comments and observations from our discussants. After that, we will open the floor for your question and comment. Please don't hesitate to ask your questions. We will take them into account. Today, we have the privilege to have 5 distinguished panelists representing different actors. Without further delay, I'm delighted to introduce you to our panelists. Our first panelist is Monique van Herksen. Monique is a lawyer trained in Dutch and US law, and the former IRS international tax lawyer responsible for APAs and mutual agreement procedure cases. Monique works in a private practice dealing with, among other things, with international tax matters. Monique serves as a transfer pricing expert of the UN Transfer Pricing Committee since 2010. And she assists the United Nations Financial for Development Office with technical matters for tax authorities in developing countries. Our second panelist is Raffaele Petruzzi. Raffaele is the managing director of the Vienna University Transfer Pricing Center. He is the author of many publications on international tax and transfer pricing topics. Raffaele is also an international tax advisor. He regularly cooperates with international organizations. Raffaele is active member of the United Nations Subcommittee on Transfer Pricing. Our third panelist is Riva Aliba. Riva has worked on public policy advocacy for over the last 10 years. Riva is currently the tax justice strategist for Oxfam in Kenya. Our fourth panelist is Ingela Wilfors. Ingela is director of the Tax and Custom Department for the Swedish Ministry of Finance. Ingela is representing Sweden at the OECD Committee on Fiscal Affairs and the Inclusive Framework on BEPS. Since 2013, Angela is a member of the United Nations Committee of Experts on International Cooperation in Tax Matters. And since 2017, Angela is co-coordinator of the UN Subcommittee on Transfer Pricing. Last but not least, our fifth panelist is Manuel de los Santos from the OECD. Manuel joined the OECD Transfer Pricing Unit in 2016. Since then, he has contributed to the major transfer pricing project of the OECD, including leading the project on financial transactions, which lead to the publication of the new chapter of the OECD transfer pricing guidelines. Before joining the OECD, Manuel worked for the European Commission and the Spanish tax administration, mostly in the field of international tax and transfer pricing. Now, I would like to hand over to our first panelists, Monique and Raffaele, to give us an overview of the new chapter of the UN Transfer Pricing Manual on financial transactions. Monique and Raffaele, over to you.
Thank you, Farid. Thank you for that introduction. Here you see the agenda of the items that we will be discussing today. Raffaele and I will both jointly address the topics, and Raffaele will give some examples. Can I get the next slide, please? So I think as Director Hanif already mentioned, financial transactions are important, as all multinationals have financial transactions taking place between the respective group members. It constitutes effective cash management. Why would you go outside to obtain lines of credit and loans if you have cash available and you can use that internally? So intercompany loans, lines of credit, guarantees for financial obligations, they're all normal and common. However, they take place regularly. They also have a base eroding aspect. Interest tends to be deductible. So it is really important to make sure that these transactions, just like everything else, intercompany, qualify as being at arm's length. So I think the most important thing of this chapter is that it should be important for anyone looking at intercompany financial transactions to get it right. What is the instrument you're looking at? And can you properly delineate that intercompany transaction? Before you benchmark it, you need to know what you are looking at. So Raffaele, maybe you can start off with an example in which delineation really is the key issue, which would be the next slide, please.
Yes, Monique, thank you very much. And I would like to thank, of course, the UN for the kind invitation and the great organization. Just to make clear, these examples are just some selected examples from the manual. We have a lot of examples there, and those were conceived by the entire subcommittee. So although here is Monique and myself presenting this chapter, there's a lot of contribution coming from the entire subcommittee, including a lot of inputs and discussions by developing countries. The explanations of the examples are sometimes simple, sometimes a little bit more complex, but we will go through some of them. And of course, for the rest, we actually ask you to read the chapter. So we have the first example here that shows how you can actually delineate the transaction looking at a specific issue of loan maturity. I hope you can all see the slide and read it together with me. So we have related party BICO that pays interest to ALCO in 2019. The loan agreement shows that the loan was made in January 2017 at a fixed interest rate of X% and specifies that the term of the loan is for a 12-month period, at the end of which the principal is repayable. At the time of the loan agreement is signed, based on BICO projected cash flows, it seems very unlikely that BICO will be able to repay the loan after 12 months. On further examinations of the facts, it is found that BICO has expanded its business since January 2017, using the loan from ALCO to purchase fixed assets. Since the principal was used to purchase fixed assets, a repayment of the principal could not be made under the terms of the loan. In addition, no repayment has been made under the terms of the loan, and BICO has continued to pay interest at X% on the loan in its 2018 and 19 financial periods. BICO and AILCO exchanged letters in January 18 to confirm the extension of the loan for further period of 12 months and repeated the exchange in January 19. So this example shows that even if the loan was initially contractually characterized as a one-year term loan, the facts at the beginning of the analysis already show that this loan most probably will not last only for 1 year, and this is confirmed also by the fact that the loan was renewed in 2018 and 2019. What does this mean? That in delineating the transaction, we have to take into account the fact that the loan has not a short-term maturity, it has a long-term maturity, most probably 3 years, probably more, we don't know, but that means that when we have to define later on the interest rate for this loan, we cannot use a 1 year interest rate, but we should use at least a 3 years interest rate. I hope I was not too fast. Back to you, Monique.
Thank you, Raffaele. So what this example shows, if you go to the next slide, is that it shows that in real life, we need to look at the components of these financial instruments, you know, whether they be loans or guarantees or any other financial instrument. And there are certain ones that are recurring and you will see again and again. You know, for an intergroup loan, we will, of course, look at a lender and a borrower. So the lender is the creditor and the borrower is the debtor. The term of the loan is important, as we just heard. You know, for what time period is that loan extended on paper and in behavior between the respective entities? What is the credit rating? So what is the risk that the debtor will be able to repay that particular financing arrangement? What is the credit rating of the loan instrument? So, you know, does it have any preference, or are there already many instruments outstanding as a result of which there's more risk that this particular one will not be repaid down the line? And what are the conditions of the loan? What is the interest rate of the loan? When is it supposed to be, when is the interest supposed to be paid? What is the principal amount, repayment obligation, or can it be extended, or is there a conversion at a certain point in time? And the same thing with respect to intergroup guarantees. We need to look at who is the guarantor, who's the guarantee, what are the contractual terms of the guarantee, but also what is the financial capacity of the guarantor? Can that party actually you know, step in and take over the repayment obligation in case the debtor or the guaranteed party you know, does not cannot perform and the guarantee kicks in? Is it an explicit guarantee or is it an implicit guarantee, an assumed? And what is the benefit that is received from getting the guarantee? These are all recurring features that are relevant to determine the pricing of that particular instrument. And the short answer here is that the higher the risk the financial instrument presents, the higher the price to pay the provider of the financing, so because it becomes more risky. So these features can also help, that we just listed, to determine if the instrument qualifies as debt or equity. Now, the manual does not prescribe when something is debt or when something is equity. That is you know, something that is to be determined under domestic law. But there are a couple of different ways to look at financial instruments, depending on how much emphasis is going to be put on this and how developed a tax authority is in this. You could look at an instrument that is presented as a loan and just say, you know what, considering these circumstances, I'm just going to determine whether that interest rate is arm's length or not. That could be the first thing. The second way to look at it is to say, like, well, we're going to look at all these factors to decide whether that instrument as a whole qualifies as debt or equity for tax purposes. If it would qualify as equity, then probably the interest paid would not be a deductible expense. if you want to get more sophisticated, you could look at this whole instrument and say, well, only part of it qualifies as debt, considering the credit rating of this particular debtor, considering the capacity it has to repay that particular instrument, and the remainder of it, should not be treated as debt, and the interest rate that goes to that part shouldn't be deductible. That is something that a country will have to develop policy on themselves, but the manual does explain that these options are out there. So there are more intragroup financial transactions than guarantees and loans. There's cash pooling, there's captive insurance, there's hedging transactions, but those are not separately discussed here. What does apply to all of them is the accurate delineation exercise. And with that, Raffaele, may I ask you to get into the accurate delineation analysis one more time, please, for the next slide.
Yes, thank you very much, Monique. And indeed, the understanding of whether something we're looking at contractually is a loan or is not a loan is something that is, of course, of key importance. This is something that we do for every kind of transaction. And so we have to do it also for financial transactions. And so we have conceived an example during the discussions at the UN subcommittee that was going into this direction, try to clarify when you can have a loan, when a loan is contractually a loan, but in fact, it could be something else. So if we look at this example, we see BICO receiving a loan from ALCO again. Looking at the characteristics contractually agreed of the loan, we see that there is no maturity date, there is no security, and that the payment of the interest is contingent to the fact that BICO is in a profit situation. So looking at the characteristics of the loan, we really have some doubts of whether this is indeed a loan. Then we go further and we look at the characteristics of the borrower, BICO, and we see that BICO uses the funds in order to develop a new business concept, nothing wrong with that. But also we see that BICO existing business is weakening. So the business of BICO is not doing that great. And also the fact that the existing and the new businesses of BICO are not projected to be able to generate sufficient cash flows in order to basically to repay the loan. So the lower amount of the interest will in fact be paid rather than the amount that was initially agreed contractually. So this example shows that even if this loan is contractually defined as a loan, probably the delineation of the transaction, the accurate delineation of the transaction will tell us that it could be understood as something that maybe is not a loan. We don't go that far in saying this is equity. Of course, this is not something that is up to transfer pricing necessary to conclude, but we say that probably the interest on this loan could be not deductible, and that the tax administration in certain circumstances, like for example this one, should go into a further analysis in order to understand whether we can consider this as a loan and whether the interest could be deductible or not. So, of course, looking also at the commercial rationality, we have to think whether BICO in such a situation would have received a similar loan to a third party or not. And when the answer is not, then of course, the answer to whether this is a loan might be probably something that is clearly not. So this is an example we conceived. Again, there's various details on these discussions in the chapter, and you can look at it after when it will be published. Monique, back to you.
Thank you, Raffaele. I think one thing that Raffaele mentioned that is really important, also in financial transactions, we will look at both parties to the transaction. It's a two-sided analysis, so you don't look at one entity only. So maybe we can move on to the next slide. So before we get to the methods that we apply, I want to get back to one aspect that we don't have on a slide, but is discussed in the manual, which is the issue of credit rating. Please know that accurate delineation also requires looking at the particular credit rating. And there are at least 3 independent commercial credit rating agencies, Moody's, Standard & Poor's, and Fitch, that provide investment graded ratings for companies that range from AAA to CCC ratings. Ratings above BB are considered investment grade, and below BBB are deemed below investment grade. The importance of that is, again, the riskiness of the party that is actually the debtor. So I think going back to the transfer pricing methods, the comparable uncontrolled price really is the most common method used. You could have an external comparable uncontrolled price method where you use the databases and look at the amount of the loan, how long the amount of financing is provided, the repayment terms, the credit rating of the parties involved, the credit rating of the instrument involved, the country, to get country risk. All of that is provided in these databases, and we can compare what an unrelated party cost would be, the price would be for such a financing arrangement. The transaction net margin method is listed in here, but that is particularly for an entity that provides like pass-through loans or renders financial services. So it's not for the instrument itself, but it's for providing the service of facilitating these loans. The profit split method we see for more complex financial structures. And now the simplification measures. There are some countries that may wish to use simplification measures. And I'm just going to mention one, which is something along the lines of the 6th method that we know from several developing countries and Latin American countries. And those countries may like to refer to the equivalent of what used to be the London interbank borrowing rate, but now the local equivalent, as the price to pay, unless the taxpayer can rebut that, because we do realize that simplification measures are very important in this respect as well. When we get to methods, Rafaela, I know you have an example on which we can discuss what method we could preferably use. So maybe I can hand it back over to you.
Yes, thank you, Monique. And indeed, we have some examples also on these topics in the new manual. The first example goes into looking at how to apply the external cap method for intragroup loans. It is important to mention that when we want to price intragroup loans, probably this is the kind of transaction in practice where we have the most amount of information. So we cannot say that loans are difficult to price a priori, because we have a lot of information out there. We have information in publicly available sources. Sometimes these sources are contained into database that you have to pay for, but that is not the only case. You can find a lot of information also out there that are free of charge, and you don't have to collect them from databases. So this should be really important, and should be underlined. And this is something that we try to show also into this example. We have, again, BICO getting a loan from ELCO. Basically, we have to understand what could be the interest rates that BICO should pay to ELCO. And of course, in case we want to find out what this interest rate is, in some cases, we might refer to interest on other loans. In some other cases, when we don't have information on interest on unrelated party loans, we can use other realistically alternative transactions like bonds. So in this example, we simply say, if you don't find information on loans, also information on bonds can be used. And those are, again, publicly available. In certain cases, when you look to some information from bonds, maybe you want to refer to yields to maturities or options adjusted returns. This is something a little bit more complex, but doesn't mean that you have to use them all the time. And therefore, you might have to take into account also some issues like illiquidity premiums. But again, those are all comparability adjustments that you can make in practice because there is a lot of information available. So I think the next one is also another example. So I will just go ahead with this one. This is an example on pricing guarantees. So in this case, we have BICO that has requested a 5-year loan from a bank, from a third-party lender. ELCO has provided a guarantee for this loan, and the third-party lender has provided the loan to BICO at an interest rate of 2%. ELCO has a rating of single-A, while BICO has a rating of BBB, considering also the impact of implicit support. And based on information on publicly available sources, we can define that the interest rate that a third party would have paid would have been 3.25%. So without the guarantee, BICO would have paid 3.25%. The conclusion of this example is that most probably the guarantee fee should be maximum the difference between 3.25, so the interest that BICO should pay without any guarantee, and 2%. That is the interest that BICO is actually paying, because of course that means that BICO is getting a benefit out of that guarantee that is 1.25%. So of course, this is the maximum amount people should pay as a guarantee fee. In the example in the chapter, we make it clear that we can take into account also of some bargaining power by BICO. We can take into account of splitting the benefit between BICO and ELCO. We can take into account also the cost approach, which is something that we also describe into the chapter with another example. So there's other adjustments we can make to this, but we just wanted with this example to show you what could be one of the ways to price intragroup guarantee fees with a cap. Monique, back to you.
Yeah, thank you, Raffaele. So I see a lot of questions are coming up in the Q&A that I hope we get to answering. Can I get to the next slide, please? Just in a nutshell, okay, so what are we seeing in this particular chapter? First of all, there's a discussion of the financing arrangement within a multinational entity group. Credit rating was mentioned, and you need to realize that that is an important aspect. There's a lot of international litigation in this area. And, you know, do we look at standalone ratings? Do we look at group ratings? You know, that is something that you really should carefully consider. What is the chance that a group company will go bankrupt in case it cannot serve its external financial obligations? You know, that is the question you ask yourself when you're looking at a guarantee. And when you're looking at, is there implicit support? Is that relevant, or is there explicit support? You know, the accurate delineation is really the heart and soul of the arm's length standard. So you really should go through all the characteristics of the instruments that are presented to you that as financing instruments, and after that you apply the arm's length principle. There's several debt equity questions that are coming up. You know, the whether that should be governed by domestic law or not. I think we're going to get into that in the discussion, so I'm not going to address it right now, but I hope we do get back to that. The characteristics of the intercompany loans and guarantees, we listed those in the chapter, addresses those, and the methods are discussed. And there are 16 case examples, of which Raffaele presented some. And they all were group efforts and came from the developing countries. So I think with that, the credit really goes to the UN Tax Committee for requesting that this topic be addressed as a separate chapter in the manual. And I think this is the moment that I hand it over to you, Ingela, for further discussion and asks. And thank you for, again, allowing us to develop this chapter with everybody else.
Thank you very much, Monique and Raffaele, sincerely, for your excellent presentation. You have summarized many years of work in a few minutes, so in a clear manner. Thank you very much. Now I would like to hand over to Riva, and I would like to ask you if you could please tell us the civil society perspectives on how the new guidance can help developing countries. Riva, over to you. Thank you.
Thank you so much, Farid, and thank you to the committee and subcommittee for its extensive work on updating the manual. I just wanted to situate these updates in the context of conversations that are happening in the world at the time in relation to moving beyond the arm's length principle. You know, we see this happening in the inclusive framework. We have several groups have mentioned a more simplified approach, including unitary taxation. And we see a lot of initiatives that really would complement moving beyond the arm's length principle, such as country-by-country reporting, automatic exchange of information. So it's really just the idea that the manual is based on this principle, but it is a hypothetical one. And multinationals really don't organize themselves or behave in ways that separate entities would. So as much as we don't have a fully fleshed out alternative, I think it's worth expending energy on interrogating another one, and a more simplified one. That's related to my second intervention, which is around the capacities of tax administration authorities, especially in developing countries. We know that not a lot of developing countries, and least developed countries in particular, have transfer pricing regimes. And where they do, there is minimal capacity or to actually undertake the kinds of analyses that this manual is recommending. So there will be always a huge information asymmetry between corporate and revenue authorities. So it's really just the proposal to one, whether the committee could look at alternatives beyond the arm's length principle, and two, whether they could consider more, whether there could be another space for revenue authorities that don't have the kinds of capacity, whether information-wise or skills and expertise-wise, to kind of implement the recommendations and proposals that are in this manual. Thank you so much. Back to you, Farid.
Thank you very much, Riva. I think it's always inspiring to get the civil society point of view. And thank you for getting too brief, but you are really precise in your presentations. So now I would like to turn on to Ingela. Ingela is an active member of the UN Tax Committee and co-coordinator of transfer pricing subcommittee. I would like to ask you if you could please tell us on how the guidance was developed and enlighten us on the approval process of the charter, because it's always good to know the background, how things come to, and to understand better things. Over to you, Ingela.
Thank you so much, Farid, and also thanks a lot for inviting me as a speaker on this, I think, very important subject for developing countries' financial transaction. And I'm really, really happy that this webinar is taking place with so many attendants. And I guess that is one of the advantages with having, being able to do it on a webinar instead of doing it on a physical meeting, which normally is maybe a bit nicer. So yeah, as you said, Farid, I quite often get questions on how the subcommittee process actually works. And I would therefore like to take this opportunity and start by saying a few words about that. So the process is from the start that is the tax committee that decides whether to have transfer pricing at all on the 4-year term, or whether not to have it, whether to establish a subcommittee, and then finally to decide the mandate. And when that is done, if that is done, then the tax committee nominates coordinator, or as in this case, co-coordinators, to take the lead on the work. The mandate of the current subcommittee is very flexible. Well, in short, and thank you for putting on the slide, it emphasizes, the link to Article 9 that is very important in the UN model. It also put focus on BEPS, base erosion profit shifting issues, and also establish a focus on the least developed countries. So we have to have that in our sight. But of course, with such a broad mandate, you need further meat on the bones. So how do you actually know what the most pressing issues are and relevant issues for developing countries? What are the issues that the manager should focus on? Well, maybe that is not an easy question to answer, but of course you have to, I think, ask the developing countries. And how do you do that? Well, I think, as also was mentioned earlier, how you get into this work, capacity building events. And we started up our 4-year mandate in the subcommittee by a capacity building event in Swaziland. And there we picked up some very important issues, for example, financial transaction. Also, I think conferences or webinar like this, that's excellent. So please, as Mr. Hanif was saying, you must really, it's good that you ask questions, but also fill in the survey in the end, say what you think is important. I think that's really very important to get that input when we have this opportunity. We also look at what other international organizations are doing. For example, the platform for collaboration on tax, that is very relevant. And we picked up the comparability issues, which I think is a frequent asked question. What do you do when you have no comparables? So I think that is also what you can do. And of course, now I look at Manuel, the OECD. It's not to duplicate what the OECD is doing, but to dive into areas more in detail and to enhance the explanation, adding more example. And also, I think here the financial transaction work in the subcommittee is a very good example of that. So with everything, there's a lot of interesting work you can do, of course. But why did we actually put the intra-group financial transaction highest on the agenda? Because that's really what we did. Well, I don't think I have to say much about that because it's already been said. It was stressed by Mr. Navid Hanif, and it was stressed also by Monique. I think also Michael mentioned a few words about that. So I don't have to go into that, but just to stress, I think the base erosion and profit shifting issue related to intra-group financial transaction, which I think is very important and relevant for developing countries. And I think also when you have the OECD transfer pricing guidelines, it's a very theoretical framework. It's good, but it's very theoretical. And it is evident that more practical guidance was needed. So then, what about the difference to the OECD transfer pricing guidelines? Is the manual only a copy? I think I already answered that by no, it's not. Although it's consistent with the financial transaction chapter of the guidelines, there are also many differences. So first, the manual focuses only on the most important issues for developing countries, as Monique and Rafaela mentioned earlier, and that is intra-group loans and guarantees. So why did we not, for example, focus on cash poolings, captive insurance? I think the easy answer is that we had to prioritize our time. We had 6 to 7 other different work streams to be able to go through and finalize within the 4-year period that we have. So I think the key topics of loan and guarantees, it was important that they would be addressed and clarified as soon as possible. Also, I think as Monique mentioned, to equip that was a difficult word, developing countries with the tools, to be able to delineate such transaction and very importantly, be able to ask the right question when they're auditing these intercompany financial transactions. So that is, why we just focused on these focus areas, which of course is different to what the transfer pricing guidelines is doing. And I think maybe another even more important difference is that the manual, I mean, it really puts financial transaction into a context. It makes it understandable, even if you're, I mean, if you're a transfer pricing expert, I mean, maybe like me, but maybe not focused on financial transaction in particular. And then I find it, for myself, I found that to be very useful, in particular as a supplement to the guidelines. So I think that's also, I think, a very important difference. So, I mean, it's not only theoretical guidance, but it's practical. And as Monique explained earlier, it really describes the importance of corporate financing decision for an M&A and how that can lead to BAPs. It describes common types of intra-group financial transactions, their characteristics, and also, I mean, how the arm's length principle should be applied. And I think that, as also, I think Raphael and Monique didn't have so much time for examples, but I mean, I think the quite detailed description of credit rating I find to be particularly interesting myself, explaining what credit rating is, how it is done, and why it's relevant. And then added to that guidance is an example of the relevance of implicit support on a company's credit rating. And I think that is really quite helpful. And the 16 examples already mentioned, well, they are linked to different sections of the chapter. So, for example, when you read about the accurate delineation of a transaction, then there are directly examples linked to that. And some examples, well, they are very basic, but some are really much more elaborated. So a bit more than about the work of the subcommittee. How is it done? Well, before going into that, I would first like to present the subcommittee with a picture, which is on the next slide. So there you can see the very nice University of Vienna, Wirtschaftsuniversität. And you can see, I don't think everybody's present, but I mean, this is a really very nice group of brilliant experts on transfer pricing. And I think it's what this brings, if you compare it, for example, to the OECD, is that it brings very exciting, lively discussions, which, I mean, the OECD can also do, but here you have multi-stakeholder group, 27 members from different countries. And also, I would like to stress that many developing countries, we have worked very hard to get them involved, and they have worked really hard. And I think that is so important for this subcommittee. And then, I mean, compared to the OECD, we don't have only members from government, we also have tax authorities, and tax authorities, but also from business, from academia, advisor, and that I think gives a broad perspective on different issues. And you look into those issues from different angles, which I think has been a really exciting to do that, and I think you develop your perspective of things. But then the OECD has a very good secretariat with Manuel and others on it. We also have very good secretariat, but they are very few. So in the beginning, we only had Michael Leonard and Irving, and now in the end also Ilka. But they have to do everything, not only transfer pricing. So we are very dependent on having different drafting groups. And as was mentioned before, Monique and Raphael has really been the main drafter of the financial transaction chapters, and I'm really very impressed by their work. So, so the draft that they presented were discussed at least 3 to 4 physical subcommittee meetings. It was really our main and most important work stream. And the last subcommittee meeting, very luckily, was held in February 2020, 2020, and that was in Vienna. So it was just before the pandemic. It was actually my last journey before then working from home. So we were lucky there. And I also think what is very important with the work we're doing is that the link to try and link it to capacity building events, a bit like this. But we also linked our meetings of the subcommittee physically to that before. And we did that in Nairobi. I was going to say last December, but maybe that's the wrong word. December 2019 is the right one. So if maybe we can go back, if you have had looked at the now subcommittee to, yeah, thanks. So how do we get approval by the tax committee? How does that work? Because we do a lot of work for 4 years. Well, as this work that we're doing progresses, different parts were presented. So we have had 3 different parts on financial transaction. And then each part has to be approved by the tax committee twice. So there's a lot of going back and forth, but that's also very important because at the same time we publish the drafts on the UN website and we ask for comments. So please, you in the audience, you have to look at the UN website and give input because I think that's very important to get the input in particular from developing countries. And I think it's important to be as transparent as possible. And also the sessions when these issues are discussed by the tax committee, they are open to everyone. So you can attend those as well. So I think it's I'm really very, very happy that we had the approval by the tax committee already in October. So now everything that we're ready for is and looking forward to is the new manual online version. So finally then, a few personal thoughts on possible new issues maybe for the future. I think I mentioned before insurance, captive insurance, and I think if we would have had more time, we would have done some work on those as well. I think they might be interesting also for developing countries. And I think the guidance in the transfer pricing guidelines is actually quite complex here. Another issue that's maybe or maybe not should get into the financial transaction area is foreign exchange gains, losses, hedging gains, losses, and cost. I think that are issues and questions that come up a lot in developing countries. And another one that we actually discussed, but we couldn't include it in the financial transaction chapter, that was performance guarantees. And it was discussed in the context of extractive industry. So maybe that is also an issue to look into. And if you go further away from the financial transaction, I think it will be quite helpful to do more work on simplicity, to look more at safe harbors. I think that would be helpful. And also, I think more guidance on the COVID-19 because of or transfer pricing related issues because of the COVID-19. And I think there was a seminar 1 week ago, which I thought was very interesting. It brought up a lot of issues, and I think that could be really an area where for the future work, if there will be a next subcommittee for the year. So having said that, I just want to finish by saying thank you all for listening, and back to Farid.
Thank you very much, Ingela. I think it's an excellent presentation. I love the photo. I think it's an excellent souvenir from the subcommittee group, and I think it's always good to understand how things come. And then thank you for your clear presentation. Now I would like to ask Manuel from the OECD to give us an overview of the work of the OECD on the topic. Manuel, over to you.
Thank you so much, Farid, and thank you so much, everyone, for joining us today. It's a real pleasure to be here again as last week on the webinar of the COVID-19 pandemic, but today focusing on something that is specific, especially relevant for transfer pricing nerds, as we all are, I think. This is the work on financial transaction, and I'm very pleased to share the panel with such a devoted experts on transfer pricing. And I'm also happy to have some of the Working Party 6 delegates around. That always make things easier in case the Secretariat says something that is nonsensical. So I guess to start with that, as for the UN manual, the chapter on the transfer pricing guidelines related to financial transactions have been longly awaited by the public. And I think that's because we transfer pricing people, we always had the feeling that something was missing in the transfer pricing guidelines. And that's the specificities of financial transaction. That doesn't mean that financial transaction couldn't be addressed through a transfer pricing guidelines before the publication of the chapter, because the principles are there and the general ideas are there. But I think it's helpful, and the feedback we've received so far on the chapter has been quite positive, in the sense that it outlines the application of the Artland principle and the principles in chapter 1 in particular to a number of financial transactions. The guidance that we published last year, in particular in February 2020, it's relevant once again because it's been approved by the whole inclusive framework. And that means that the chapter represents the consensus view of over 135 countries. And that's something important in order to achieve the final goal of the transfer pricing guidelines, that is, at the end of the day, minimize dispute and avoid double taxation. So in that respect, I think during the process of producing the guidelines, or this particular chapter of the guidelines that took us over 4 years, we benefited quite a lot from the inputs of stakeholders. So if you recall, back in the day, 2018, we managed to publish a non-consensus discussion draft on financial transaction. We got quite a number of inputs based on that public consultation, and that allowed us quite a lot in, and not in the Gordian knot, and get the final consensus that it's there in the final chapter published in February last year. I think what I'm going to do is just very briefly, in the interest of time, just giving you a number of hindsight or highlights of the content of the guidance, and I'll be very happy to pick up any comments or questions you may have. I'll try to focus on the aspects of intragroup loans and financial guarantees as well, just to mirror the explanation of the previous panelist on the UN manual, though it's true that the chapter 10 of the transfer pricing guidelines covers quite a lot of issues that go beyond those aspects of financial transactions. But to start with, for instance, I think it's important to acknowledge that the chapter recognizes the specificities of the financial services industry. And that doesn't mean that financial services industry is exempted or excluded from the scope, let's say, of the transfer pricing guidelines. Just on the contrary, it means that there are specificities of that industry, in particular when it comes to the heavy regulation of that industry, that have to be taken into account when performing the transfer pricing analysis. And that's not anything different from what is already included in chapter 1 of the transfer pricing guidelines. The second point, I think, in the introductory language of the chapter 10, and I think that's critical, and that was actually critical to get the document approved, it's you have a look at paragraphs 8 to 10 of that report, and they elaborate on the interaction between the application of Article 9 to the capital structure of an entity and domestic provisions dealing with the same issue. I think that's important because it clarifies how those rules interplay, and in particular, the guidance states that the new chapter 10 does not prevent countries from implementing approaches different than transfer pricing to address the issue of the capital structure. Also, I think it's important to stress that those paragraphs are framed within a footnote that alerts the reader about coming changes in the commentary of Article 9. And I think that's something I would be happy to pick up during the Q&A question, because it's something important in the coming months. As you know, the Working Party 1, it's actually, as we speak, modifying the commentary on Article 9. And I think it's important to have that in mind when we are reading this particular piece of the chapter 10. Also, and I was happy to see that the UN manual addresses this point as well, is the guidance include, the transfer pricing guideline includes now an example on the delineation of an advance of funds, and it provides a number of indicators to help tax administration and practitioners to delineate a purported advance of funds. Importantly, I think also in these introductory remarks, and I don't want to sound like a broken record because it's something I said last week, but I think it's important to stress is that labels do not drive the transfer pricing analysis. And what I mean here is something that the guidelines repeat quite often, and Monique was also stating that at the very beginning. The accurate delineation of the actual transaction is key in order to get the things right before trying to price any controlled transaction. And obviously, the process of delineating the transaction should be properly included in the transfer pricing documentation to provide comfort to tax administration on how the taxpayer has reached to a given transfer pricing position. Beyond those initial remarks, the guidelines then get into elaborating a number of specific financial transactions, in particular treasury functions that covers as well intragroup loans, hedging, cash pool arrangements, but also the chapter deals with financial guarantees, with captive insurance. And at the very end of the report, if you have a look at the report we published in February 2020, there is a section that is section F that covers the analysis or the determination of the risk-free and the risk-adjusted rates of return. And that particular piece of the report is not incorporated in chapter 10, but rather it is directly incorporated into chapter 1 of the transfer pricing guidelines. And I think I'm going to ask myself the question I usually get when I'm presenting on financial transaction, and is when this chapter is going to be actually incorporated in the transfer pricing guidelines. The answer is that the chapter already forms part of the transfer pricing guidelines. And we are planning to produce a consolidated version of the guidelines, hopefully before the end of the year. So we will have everything packed in the same PDF or in the same hard copy of the guidelines. But that doesn't mean that the new guidance on financial transaction is not already part of the transfer pricing guidelines. Then, as I said, moving quickly into those specific financial transactions, if we start with the treasury functions, the guidance provide, I think, a useful message by saying, like, usually treasury functions are generally seen as ancillary services, and in those cases, the pricing of those services will be governed by the guidance in chapter 7. And then the chapter moves into the analysis of intragroup loans. And I think I'm going to echo here what Monique and Rafael said at the very beginning of this panel, in the sense that it's important, it's critical when performing a transfer pricing analysis of an intragroup loan to take into account the perspectives of both the borrower and the lender. And I think it's important to underscore that, because usually when it comes to the analysis of an intragroup loan, sometimes we tend to focus too much on the features and characteristics and the perspective of the borrower, but the lender's perspective has also to be taken into account in order to make sure that we are replicating in this controlled context the forces of the market. Also, in that particular point, the chapter elaborates on the importance of credit ratings, and it's cautious, and I think that's something that has been echoed in the UN manual. It's cautious about the use of publicly available financial tools, and the reason for that is that often those tools rely on quantitative factors and they completely disregard qualitative factors, and sometimes those factors, those qualitative ones, are as important as the quantitative factors to determine an appropriate credit rating. In terms of credit rating, the chapter builds upon what is already in chapter 1 and chapter 7 regarding the analysis of implicit support or the incidental benefit of just belonging to an M&E group. And in that respect, I think it's nothing groundbreaking. It's the same principle as in chapters 1 and chapter 7. When it comes to pricing mechanisms for intragroup loans, the chapter highlights the preference for caps, and it also expresses concerns when it comes to the use of credit default swaps. And the reason for that is obviously the intrinsic volatility of those instruments that could affect the proper pricing of that of those transactions, of intragroup transactions. Sorry. Then moving into financial guarantees, the chapter makes it clear that it addresses financial guarantees, but understanding those as the legal agreements where the guarantor is committed to step in the place of the guaranteed party when the guaranteed party defaults into its obligations. And one of the points that the chapter stresses, and I think Monica was also touching upon this at the very beginning of the panel, is that it's critical to understand how and when the guarantee is providing a benefit to the guaranteed party. Importantly, I think the benefit of the guarantee, it doesn't get limited only to getting enhanced borrowing terms for the borrower, but it could be also the case that the guarantee is allowing the borrower to get access to a larger amount of funds. Also, I think importantly, the guidance in the transfer pricing guidelines acknowledges the possibility that the guaranteed party could get a benefit from a guarantee in those situations where the guarantor does not actually have a better credit rating than the guaranteed party. And I think the guidance here notes an example as, for instance, when that situation allows the lender to have access to a wider pool of assets as compared to the pool of assets that could have access if only looking at the guaranteed party. As well, when it comes to the analysis of the guarantor, the chapter elaborates on the need to ensure that the guarantor has the financial capacity to provide a guarantee. And I think very importantly as well, the guidance in this particular section on financial guarantees include 3 useful examples to explain or to elaborate on the delineation of the guarantee and when the guarantee provides an actual benefit for the guaranteed party. And I'm going to touch upon very quickly another couple of points in the guidelines that are not covered in the UN manual, but I think it would be good also maybe to foster some discussion later on. One point is the issue of cash pool arrangement, where the transfer pricing guidelines put a lot of stress on the idea that they have to be short-term agreements or arrangements that are aimed to manage, let's say, efficiently the liquidity of an M&E group. In that particular case, when it comes to the cash pool arrangement, the guidance notes that generally cash pool leaders perform coordination and agency functions, and therefore in those situations they could be seen as not assuming under the Chapter 1 guidance the relevant risks of the cash pool arrangement, and that will obviously impact on how those functions should be priced. This point it's illustrated through a couple of examples in the guidance where you can see the differences between a cash pool leader that actually performs merely as an agent or a coordinator as compared to other situations where the cash pool leader could be understood as assuming more relevant risk and then being entitled to a higher remuneration. When you look at the cash pool members on the other side of the transaction, the guidance elaborates on the fact that no cash pool member would be expected to participate in a cash pool arrangement when that leave that participant worse off than their its next best option. And when we analyze when a participant is better off by participating in a cash pool arrangement, again, the chapter elaborates and highlights that it's not only an enhancement of the interest rate, the fact that the feature we have to look at, but there are many other features from which the cash pool member could benefit and participate in a cash pool arrangement. Like, for instance, getting a quick access to liquidity that couldn't get in the open market otherwise. Then the guidance as well includes a section on captive insurance. And in that particular one, the guidance basically leverages on the existing guidance in the 2010 report on the attribution of profits to permanent establishment. And it sets a number of indicators in order to understand when a captive insurance is actually undertaking a genuine insurance business. And I think that's critical. And I've been precisely this morning reading something, some case law on that particular case. And it's nice to see that the case law is aligned with the ideas that we covered in the Chapter 10. But also those ideas, those indicators are based upon those indicators that were already included in the action in the BEPS Action 3 report on CFIs on defining insurance business. Importantly, I think when it comes to captive insurance, I had to say what are the most relevant indicators in order to understand and delineate the transaction properly. I would point out to the need that the captive insurance achieves risk diversification and capital efficiency, as those are the key issues that third parties look at when undertaking insurance business. And finally, to close, without getting, just not to get Farid upset with me for extending my time, I would like to say that the guidance is relevant because it covers a number of fact patterns that were missing in transfer pricing guidelines. And I think that's, as some of the panelists before said, that comes from a demand by developing countries. So I think that's very positive. We were able to deliver those items upon such demand. I think it's also important because it provides a number of examples and in some parts it's quite detailed, and it provides practical guidance that it will be helpful for, I wouldn't say only developing countries, but in general for tax administrations. We are talking about quite a sophisticated and complex issue, so that will benefit any type of tax administration and practitioner, I would say. And finally, and I think the most important issue is that the chapter was developed and produced by the inclusive framework. So that means that the view of all the actors and players were absolutely taken into account in producing the guidance. And I think that's something always positive and an important message to underscore. So having said that, again, thanks a lot for the opportunity, and Farid, back to you. Very happy to pick up any comments or questions.
Thank you very much, Manuel, for giving us an overview of the OECD guidelines and then talking about the way of the approval of the manual. And thank you again for your collaboration and cooperation with you, and thanks a lot. Now we are going to handle the question from the audience. I will ask the panelists just to turn on their camera so that we can. Fine. We have received many questions and comments from the audience. We are doing our best to answer all of them, and then we may take some of them in our future events and workshop for that. Thank you all for asking. Keep asking questions, although we're starting the question and answer session. So I will start with the question that address similar issues. So we're gonna do like a round of questions. So I will start by the first round. So we have a question from India. It's about, we'll ask 2 questions, then I will ask the panelists to comment. You can choose which one you want to reply to, and then we go to the second round and so on. So our first question is from India. So what are the challenges we can foresee in delineating the loan? And our second question is from Lesotho. What do we do in case where we find that this is not the actual loan based on its characteristics? Example, no maturity date, no security. Up to you, who would like to intervene, please. I'd like just to ask you to be concise in your answer. Feel free.
Sure. I don't know, Rafael, do you want to go first, or
go ahead?
What do you?
Go ahead. I'll add on something after you.
Okay. So the challenge is to delineate a loan is to actually get the facts, and the good thing about the manual is that it lists these characteristics, these common features of an instrument. So I think you should have no hesitation to ask about all of those. Is this an issue? Is this an issue? What is happening there? And just, in the world of transfer pricing, there's no shame in continuing on asking questions and saying, so what is happening here, and what is happening on the other side of the transaction? So I think the biggest issue is that you just get a one-sided view. So you really want to make sure you get a dual-sided view of the intercompany transaction. And that way you have the best opportunity to delineate that transaction.
Excellent, yeah. I don't know, Rafael, I would like to add something.
Just to stress out the fact that in this process it's important to collect the information clearly, and therefore a good transfer pricing documentation is something that needs to be asked to the taxpayer in case you are reviewing the transaction. So yes, feel free to ask the taxpayer documentation, because otherwise you will not be able to delineate properly the loan.
Yeah. And what was the second part, Farid, of that transaction? There was a second question to it that I actually...
Yeah, I may say the second question from Lesotho. What do we do in case where we find that this is not the actual loan based on its characteristics? No maturity date, maturity, nothing.
Yeah, somebody was already answering that question in the Q&A, saying like, well, in that case, you just ignore it and you add the interest, you disallow the deduction at the interest back. Yeah, that's one way to go about it. The other way is to say like, well, what is the information that was submitted to the other tax authorities, assuming, you know, that is a country that is transparent, and you could arguably, through exchange of information, ask for that information. But you could just, you know, go back to the taxpayer and say, I really want a clear view of what the related party on the other side of transaction is reporting for tax purposes, to help you with the delineation. But yeah, I think the bottom line is, if you don't get the information you need, you disallow it. You know, this is not rocket science. You know, taxpayers just have to be very clear on intercompany transactions.
Thank you for that. I don't know. Yes? It's okay, thank you. Manuel and Ingela, feel free to answer if you would like to. So I would like now to go to the second pool of a question, and then we have some questions from Zambia. So I will read the question is, how often do you see upstream guarantees where the subsidiaries guarantee a parent's financial instrument, and in what instance would the parent company have a lower credit rating than its subsidiary? I will read it again, and then I go back to the second question, which is quite a different stream. How often do you see upstream guarantee where the subsidiary guarantees a parent's financial instrument, and in what instance would the parent company have a lower credit rating than its subsidiary? And the second question is the same. It's from Zambia also. So with regards to the notching principle, do we always take the principle that the bureau assumes the guarantor's credit rating, or do we simply make a determination on how many notches up the guarantees provide to the borrower credit rating? I will read it because with regard to the notching principle, do we always take the principle that the borrower assumes the guarantor's credit rating, or do we simply make a determination on how many notches up the guarantee provides the borrower credit rating?
Maybe I can quickly provide a feedback on this. First of all, it's really interesting to see that there are these questions go really into the details of these transactions, which shows that there is indeed a lot of knowledge in developing countries, and so we are really happy to see that this is a work that hopefully will help developing countries in finding out solutions to these questions. So in what situations do you see upstream guarantees when a subsidiary, basically an upstream guarantees when a subsidiary provides a guarantee to its parent company? This you could see it in some industry practices. For example, in real estate, in the real estate industry, when the parent company requests a loan to a bank, maybe the bank asks the subsidiaries, the ones who actually own the real estates, to provide upstream guarantees in order to support that loan. So this is something that some industries have as a common practice. I don't know, Monique or any other speaker who has other inputs on that.
Yeah, no, I think the bottom line is, you know, whoever has collateral with which, you know, in case of default, that party can step in to make whole on the debtor or the guaranteed party's obligations, is going to be the party providing the guarantee. So, you know, in your delineation, you're going to actually ask whether whoever provides the guarantee can deliver. You know, is that just a paper guarantee, or is there access to funding or collateral that can serve to do that? So the example that Raffaele gives makes perfect sense. this is where the subsidiary has the collateral that has actual value, that holds the real estate, and the parent company wants to engage in transactions and needs financing for that. So where the collateral is, that's where the guarantee is sourced, if you will.
Sounds good. Yeah, I don't know if some of the panelists would like to say any comments or something like that. So I will go now to, yes.
There was one on the second one was on when the subsidiary has a better rating of the parent. So whether there are situations in practice. Yes, there are situations. There are many situations in which the subsidiary can have a better rating of the parent. We should not forget that the group rating, so the rating of the entire group, is nothing else than the average of the ratings of the various subsidiaries of that group. So in various situations, the subsidiary will be below the rating, but in other will be above the group rating. So those circumstances, you address them by either recognizing that the subsidiary has a better rating of the parent and leave it like that, or you can take into account synergies, so the so-called implicit support when it comes to intergroup financing, and say that in that case, you might recognize that there is a negative synergy, and therefore the rating of the subsidiary, even if standalone is better than the one of the group, cannot be, in fact, better than the group. And so you apply the so-called parent ceiling, and therefore you cap the rating of the subsidiary to that of the group. So this is, in short, an answer.
Yeah,
and don't be surprised that sometimes you don't have any credit rating, because not all companies have a credit rating. Okay, and having a credit rating conducted, mid-sized companies may not have that. So having a credit rating established is actually an expensive effort to do. So you shouldn't assume right from the get-go that every company you deal with has a credit rating. So you may run into interesting scenarios there.
Right. I think it's come up to a new comment that we just received from the participants. So I turn to the third round or next round of the questions. So this question was answered by Monique, but I will ask maybe Manuel can comment. I think this from TP update. Aside from having a thin cap rule, an interest deductibility rule, what other rule can you use to change the characteristic of a fund from a loan to equity? And I would say another question from, well, it's related to the credit rating, but it's about financing. Are the credit rating of both the lender and that of the group an important consideration for intra-group loan? So I don't know. I will read again the question. So that's this is from TP update. Aside from having a thin cap rule, an interest deductibility rule, what other rule can you use to change the characterization of fund from a loan to equity? Interesting that. The second question, are the credit rating of both the lender and of the group and that of the group an important consideration for intra-group loan? I don't know. This second question is, anyway, I'm just trying it to read it on high voice.
Manuel, do you want to?
Yes.
Manuel, do you want to go first?
Yeah, happy to do so. So you and Rafael can take a break. But I think that goes to the point we were discussing during the panel. In particular, I was highlighting the clarification that we have now in the transfer pricing guidelines between the interaction between domestic law and the application of Article 9 to the capital structure. And I think the question is a fair one, right? It's like beyond what is usually seen as like thin cap rules, what are the situations you can envisage where domestic provisions could, affect the transfer pricing analysis? And I think, to me, I mean, what came to my mind is the idea of, like, for instance, case law and jurisprudence. So we have quite a number of countries that have built up, a number of indicators during time that, I mean, I wouldn't say they're like a checklist, but it's kind of a checklist where you can see the number of indicators or features of a purported loan that have to be checked out before concluding that the loan is actually a real one, an actual one. And obviously that's one of the analysis under domestic law, or the jurisprudence of the particular jurisdiction that has to be taken into account, and that interplay with Article 9 has to be considered in light of the new guidance and also the commentary in Article 9. And I think, Farid, just because you made another one now on credit ratings, but also linked to the one you made before, when you are analyzing the guaranteed party and the benefit of the guarantee could provide to that, whether you are going to use just the credit rating of the guarantor and just replace the credit rating of the guaranteed party, or do you want to do something different? I think, unfortunately, you have to do something different, I would say, because if you just take the credit rating of the guarantor, you are, let's say, disregarding another number of benefits that the guarantor could provide that are not reflected only in the credit rating. So that goes to the point we were discussing before as well, about the fact that you could have a situation where the guarantee provides a benefit to the guaranteed party, even in a situation where the guarantor does not have a better credit rating than the guaranteed party.
Thank you, Manuel. I turn to another question, which is really touched a lot of developing countries. I will start by a question from Zambia. What's your take on loan that is borrowed? What's your take on loan that is borrowed in USD from a parent company in a different jurisdiction, then converted to the subsidiary currency and subjected to the lending condition of the subsidiary's country? It's a difficult question, but I know it comes a lot from developing point of view. So I'll read it again. What's your take on loan that is borrowed in USD from a parent company in different jurisdiction, then converted to the subsidiary currency and subject to the lending condition of the subsidiary country?
Yeah.
So
I can make some preliminary comments here, and then maybe the others can jump in as to their thoughts. So I mean, obviously the currency in which a financial instrument is cast also has impact on the risk and cost of that particular instrument. Do we issue a loan in US dollars? Do we issue a loan in euro? Do we issue a loan in local currency? I come from an island in the Caribbean, so do we issue a loan in Antillean guilders? Okay. So the problem there is that all these currencies have value as well, and so if you have to convert, you have to take the risk of that other currency and the price of that other currency into consideration as well. Now, if you go to databases, you can get all that information. So it's a little bit more sophisticated in the calculation for transfer pricing purposes. But usually, you would want to be in a position that you don't have to go buy foreign currency to pay off your loan, right? Because I mean, the moment you have to pay off your loan, you have to buy the foreign currency at the rate of that foreign currency. So if that currency goes up dramatically, you may end up having to pay back a lot more of principal amount than you actually borrowed in the beginning. So all those aspects have to be taken into consideration in pricing that particular instrument. I think I'll leave it at that for now.
Just a follow up on that. So we have indeed in the chapter an example who talks about the issue of currency differences, and so we have addressed this also in the chapter. It is really important to understand based on the delineation of the transaction, what is the real currency of the loan, not necessarily into the one that is indicated in the contract. So once you understand what is the real currency, then you can make, of course, adjustments. And in practice, there is a lot of ways to do it. You can use currency swaps. You can use other tools. Again, there's a lot of information out there that you can use to make these adjustments.
Yeah, and it may interact with domestic rules on FX restrictions, right? So that should probably be considered as well, even though that's not part of the transfer pricing analysis, but that may be something that's involved in the rationale for changing currencies.
Right, that's right. And also just to add like a super quick comment for it, I think also the functional currency of the borrower is critical in order to understand, how the assumption of the foreign exchange risk is assumed in that case.
I think it's an important subject. Yes.
Yeah, and if I can add something also, I was actually going to point to what Rafael has said before. And that was also on the issue, I think, when we got the question about credit rating. If the subsidiary can have a higher credit rating than the mother company or not, and how do you deal with those issues? And I think those were actually very interesting questions, because it was also questions that were discussed in a subcommittee, and you can find guidance on it in the guidance in our manual. But also, I think that was also one of the issues that I mentioned for the future, which when you said that this comes up quite often, I think that's also the input I got. So, the issues of foreign exchange gains, losses, hedging gains, losses, costs. Those I think might be some of the issues that we could look into for the future, and I'm really happy to get input on it. So, and on another issue, which I also think goes into some of the questions that has been already asked, it's also, to think about, to don't see transfer pricing in isolation. I think Rafael went into this the aspects of documentation, which is crucial, because I often see, that you jump into methods, but you haven't done your function analysis. And how do you do that? That's you need facts, and therefore also, for countries to think about, do you need maybe separate documentation rules in your own legislation? Do you, for example, many countries may look into thin cap rules in their internal tax legislation, and Manuel was a bit talking about how that would interact with the transfer pricing rules. And maybe also, I think that many countries nowadays are looking, instead of interest deduction limitation rules, like you have an EBIT rule or you have an EBITDA rules. So for policymakers, I think it's also very important to think about, how does your transfer pricing legislation, hopefully you have one, how does that link with other provisions that you may have, and do you need maybe something more? Even if I think that, that's a theoretical framework, and that's really not enough. You also need capacity, of course. But I think it's really interesting, so far, the questions that has been asked. So thanks a lot.
Thank you very much, Ingela. I'll just go now to other type of question. I think, foreign exchange is one of the big issues that should be maybe dealt in the future. So I will just now read some questions about comparables. So does the guidance contain a practical indication on how to deal with the lack of comparables for African region? In particular, on adjustment for currency and to take into account the country of the borrower. Most of the cap available are in USD in respect to US-based borrowers. So I will read it again, and then, does the guidance contain a practical indication on how to deal with the lack of comparables for the African regions, in particular on adjustment for currency and to take into account the country of the borrower? Most of the cap available are in USD in respect to USD-based borrowers. There's another question about, it goes to the same stream, about comparables. I will just read it and then give you the floor to comment. In situation where developing countries cannot easily find comparables of uncontrolled transactions, how will they deal with such financial transactions? I will read it again and then give you the floor. In a situation where developing countries cannot easily find comparables of uncontrolled transactions, how will they deal with such financial transactions? Over to you.
Since I finished, maybe I can just start to give then I think others can get more into details. So I'm back into the guidance that we have in the manual on this, and I guess you need more specific guidance on the question. But what we did really dive into, and this is also to remember when you look at the financial transaction, that's really part of this. I mean, that's, you first have to look at the whole guidance, so to speak. I mean, how you do the actual delineation of the transaction. So that goes with any transfer pricing transaction. So you have to start there. And I think it's the same with comparability issues. If you lack comparables, I mean, how do you do? And that's, of course, a general problem. So we spent actually several meetings with that issue, actually. So there is, in the new manual, there is guidance on what you actually do when you don't have comparables, how you can do data screening and things like that. And I mean, I think the question was easily, I mean, maybe they are not easily found, and maybe you have to, I think that I think you should also try a bit hard to really to find it. It's never easily found. So I think that's something you have to think about. But I think, please, it would be very good. I mean, if you look at this comparability analysis guidance that's in here, and also I think that was taken from the platform for collaboration of tax, where I think ATF also participate. I mean, they're doing such a brilliant work, I think, on transfer pricing, in particular contributing to the inclusive framework OECD work. And I haven't looked into the guidance myself in detail, so I'm not sure if there is something more specific about Africa, but I think, yeah, that it could be good to start looking there. Thanks.
Thank you, Angela.
Yeah, the absence of comparables is an ever returning challenge. We totally understand that. I mean, in private practice, firms will have very expensive subscriptions to database providers, and then get the data from the database provider. So that is a problem. What we do point out is the simplification measures. We say, like, listen. And we give two examples, one from Singapore and one from New Zealand, just because those were, readily available and easy to put in there. But I would always start with putting the burden back on the taxpayer, who is supposed to provide you with as much information as possible to allow you to look at whether what they've done is sound and makes sense, and that they must have conducted a comparability study on intercompany financing arrangements, for sure, if it involves larger amounts. So I would always say collect that information and make sure that you ask questions on that particular information. Otherwise, I think we need to continue to look at simplification measures, and we need to look at what we can do to meet the ever ongoing demand for comparability. It is the weak spot of the arm's length standard, yet it is what the arm's length standard prescribes. We need to look at what unrelated parties do. So simplification measures is one way forward, and then further education on the use of databases and trying to get access to information that the database providers provide for more developing countries is probably an initiative worthwhile as well.
Yeah, sure. Thank you, Monique. I think I think there is a lot to say about it. And comparables, the PCT has done a great work for how to work without comparables. Now we are approaching the end of the session. I would like to thank you, all the panelists, Monique, Raffaele, Riva, Angela, and Manuel. Thank you all for your valuable contribution. Thank you also for all the participants for your questions and comments. Thank you all for investing your time with us. So see you in 10 minutes, 9:15. We will have a break and then go back to the next session. Thank you all.
Thank you.
Thank you.
Thank you.
I cannot hear you.
Hi. Think it's
Steve, can we try out your microphone real quick? Can you say something, Stig?
yes, I'm here.
No, you're not Stig, Marcos. All right. Let me resume after the short break that we just had. And in the first session that Farid moderated, we talked more about some more technical background. We had a look at the UN guidance on the topic. And now in the second session, we want to have a more practical look at the issue of financial transaction and transfer pricing. And I have 4 distinguished speakers with me. I have Richard Goldberg from the US with me. He's a US lawyer and certified public accountant. He's currently independently advising clients on transfer pricing matters. And before that, he was an in-house tax advisor for 2 large banks. So thanks, Richard, for being with us. I also have Marcos Valadao from Brazil with us. He's a lawyer and holds an MBA and is currently partner at a law firm and professor at a university. He's also a member of the UN Transfer Pricing Subcommittee and a former member of the UN Tax Committee. And before going into private practice, he was a judge at a tax court. We have Nishana Gosai with us from South Africa. She has over 20 years of experience in transfer pricing and is currently group head of tax at a multinational. She was formerly with SARS, where she was also the head of transfer pricing. And she's also a former member of the UN subcommittee and currently engaging with ATAP on cross-border tax technical issues. And then last but not least, we have Stig Solon with us from Norway. He's Director for International Tax at the Norwegian Ministry of Finance and is the co-coordinator of the UN Subcommittee on Transfer Pricing together with Ingela Wilfors, which we listened to during the first session. And he's also a former member of the UN Tax Committee. So welcome and thank you to all 4 of you. We will focus on practical aspects and Richard will start us off with a presentation on his insights.
Yes, thank you very much, Ilka. Good morning, good afternoon, and good evening to everyone. I want to thank the UN team for allowing business to provide practical input on observations and challenges relating to these new guidelines. I also want to apologize in advance that I'm going to be reading from a script for the most part. And that's because I have a lot of content I think we'd like to cover, and there's a limited amount of time. So next slide. I'm going to begin by sharing some context around the new financial transaction transfer pricing rules. Arm's length pricing of financial transactions under Article 9 is 4th in line between 3 overriding anti-tax base erosion provisions. These 3 tools apply whether or not interest expense on intercompany debt is arm's length as determined under Article 9 in the UN Transfer Pricing Guidelines or Manual. FinCap legislation is common and recharacterizes debt as equity if the debt equity ratio exceeds a certain percentage. Interest deductions are disallowed to the extent that debt is recharacterized as equity. Thin cap rules generally apply to intercompany interest and therefore may very well limit the borrower's intercompany interest expense deductions even before the tax administration decides whether or not to examine a borrower's intercompany interest from an arm's length pricing perspective. Earnings stripping rules disallow interest expense deductions exceeding a certain percentage of earnings, typically represented by EBITDA. So what happens here is that there is a cap on the amount of deductible interest expense. While earnings stripping rules are characterized by the borrower's jurisdiction as an anti-tax base erosion rule, in fact, it results in double taxation since the lender is not allowed a corresponding reduction of interest income to match the ultimately deductible interest expense of the borrower. Income tax withholding at source effectively allows the source country to recover some of the tax benefit derived from the borrower's payment of interest by imposing an income tax on the recipient. The higher the amount of interest paid by the borrower, the greater the withholding tax remittance. Query whether the source jurisdiction, the borrower's jurisdiction, considers this withholding tax offset against the tax benefit of the borrower's interest expense deduction in evaluating whether to reduce a taxpayer's interest expense deduction on audit. Once again, here there is a possibility of double taxation resulting from either no partial reclaim of income tax withholding by the lender in the event of a downward transfer pricing audit adjustment to the borrower's interest expense, or the lender's inability to reduce its residence country tax liability by the full amount withheld by the source jurisdiction on the gross amount of interest. Despite the potentially profound impact of these three powerful anti-tax base erosion tools on the borrower's ability to achieve a tax benefit from its reported interest expense, tax authorities tend to examine intercompany interest expense deductions without first considering what's left to be gained from a transfer pricing adjustment to interest expense. Second, benchmarking financial transactions in defending interest expense deductions are complex, as we've heard, and all good points by the panelists earlier, and administratively burdensome for tax administrators and businesses. Tax administrations, particularly in developing countries, may be less likely to examine intercompany interest expense due to capacity constraints relative to resources and expertise. In that sense, the tax administration's examination of intercompany lending is elective, though in the event of examination, the tax administration will have the benefit of the taxpayer's transfer pricing documentation. On the other hand, preparing a transfer pricing study in-house or retaining an external consultant to document and benchmark intercompany financial transactions is not elective. The requirement to document and benchmark arm's length pricing of intercompany interest expense is very complex and expensive for businesses. In the majority of cases, in my experience, businesses incur the cost of hiring an external advisor to assist or prepare transfer pricing support. Third, new Chapter 9 was much needed and is helpful in certain respects. Importantly, implicit parent company support is to be considered. Confirms that the existing TP methods apply, generally the comparable uncontrolled price method. Clarifies that tax administrations should not recharacterize an intercompany loan or guarantee as something else unless extraordinary circumstances apply. This is very helpful as the new rules state that extraordinary circumstances will only exist if the arrangement is not commercially rational, thereby preventing the determination of an arm's length price. This means something more than just that the arrangement is not observable in third-party transactions. Example 1 in UN Chapter 9 very helpfully illustrates the principle in that a loan agreement that has no stated interest rate, no stated interest payment dates, no fixed maturity, is not commercially rational or capable of being tested, is not commercially rational or capable of being tested for arm's length pricing. In example 1, the loan agreement is not in fact a loan, it is something else, most likely some sort of equity ownership interest. I call this extraordinary circumstance recharacterization test the quack like a duck test. If there's an intercompany loan agreement with a fixed maturity date, looks like a duck, stated interest rate, swims like a duck, and principal amount, quacks like a duck, must be an intercompany loan. Chapter 9 of the UN manual is largely consistent with Chapter 10 of the OECD guidelines. I think that's a good thing. Chapter 9 of the UN manual excludes regulated financial entities from coverage. Also, I believe, appropriate. Next slide. Business challenges dealing with transfer pricing aspects of financial transactions. Assuming the tax administration does not dispute the characterization of an intercompany financing transaction as a loan, Chapter 9 nonetheless presents interpretive challenges for both the taxpayer borrower and the tax administration. Here are some of the more significant challenges. Item 1, understanding the economics of each of the contractual terms. For example, currency. Loans denominated, as we've heard quite a lot, loans denominated in currencies other than US dollars, euro, British pound sterling, or Japanese yen can be extremely challenging to benchmark due to limited external comparables. This requires complex economic modeling, which can and should be expected from the taxpayer. Impact of fixed or floating interest rate. For example, if an intercompany loan bears a fixed interest rate and otherwise comparable publicly quoted bonds bear a floating interest rate, a comparability adjustment will most likely be needed to adjust to a fixed rate equivalent. Senior versus subordinated, secured versus unsecured, timing of interest and principal payments. If the loan, is the loan self-amortizing or a bullet loan? Those are referred to in the chapter, and they are very important in terms of evaluating risk. And callable. For example, is a 10-year loan that is callable by the lender equivalent to a demand loan? Probably so. And prepayment options. Item 2, what data sources are appropriate to use to determine the credit rating of the borrower? There are lots of different data sources, and some of them I'm probably not even familiar with, that would be relevant depending upon the currency and other facts and circumstances of the transaction. Databases that I am familiar with include S&P, Bloomberg. There's an ICE database for yen-specific lending comparables. And of course, and as I mentioned, various other country currency-specific databases that may be helpful in the evaluation. Item 3, properly adjusting an issuer credit rating to account for implicit support poses a major challenge, especially for non-investment grade borrowers that are not core or highly strategic. The table in section 9.8.11 is useful as a general guide, but only gets us so far. So items 1 through 3 are necessary blocking and tackling items required to be addressed in every situation to test the pricing of an intercompany financial transaction. Item number 4 identifies other economic circumstances that may potentially impact an arm's length pricing analysis. For example, to what extent should a group funding policy influence a tax administration to adjust or tweak the stated terms of an intercompany financing transaction? Group funding policy generally applies to external funding of a group as a whole, and not so much to internal funding policies. However, should a company have a group funding policy which also governs intercompany financial transactions, would it be appropriate for a tax administration to modify the specified terms of the contractual intercompany loan agreement? For example, suppose an internal policy states that all intercompany loans are required to be secured or bear a floating rate of interest, and that's in conflict with the contractual intercompany agreement. Which should govern in that case? A borrower's credit rating generally can not be more favorable than the sovereign's credit risk ratings in the borrower's country of residence? So this was a question that was raised in the first panel. And as a general rule, that's been my experience, that a borrower's credit rating cannot be better than the sovereign's credit rating in the borrower's country of residence. This means that all other things equal, credit ratings and interest rates may very well be higher for loans extended to borrowers in developing countries. There are incredibly complex rules in Chapter 10 of the OECD guidelines that require a reallocation of returns in excess of a risk-free return from the lender to a different group member if the lender does not possess the capacity to exercise control over risks inherent in an intercompany financial transaction and or the financial capacity to assume the risks of the intercompany financial transaction. In that event, the OECD guidelines indicate that the lender is allowed to receive only a risk-free return, and the other more appropriate group member or members will receive the excess as well as bear the economic consequences of any credit losses. This will produce unintended consequences and is virtually guaranteed to result in double taxation. Item number 5, country-unique implications focusing on the borrower's jurisdiction may include simplification measures, such as elective use of parent or group credit rating or providing a guarantee fee metrics from the jurisdiction to safely price intercompany guarantees. We're going to hear more about safe harbors shortly from Marcos in Brazil. And safe harbors, as Marcos will explain, may be mandatory or optional, depending on the country. Now, some countries may permit a cost-based method, for example, for pass-through financing. Lastly, the uncertainty of outcome is evident in country jurisprudence. One of the more contentious areas is whether a parent company guarantee or security collateral should be imputed, in effect written into an agreement by a tax authority, where an intercompany loan agreement does not reflect that term. Taxpayers have lost some cases on that, and example 6 suggests that possibility. The tougher case for that argument is an intercompany guarantee, since at arm's length, the guarantee fee deemed to have been paid by the borrower to the parent company guarantor should be closely equivalent to the interest rate savings to the borrower. So those are my prepared comments. I thank you very much for your attention to this presentation.
Thank you, Richard. I think you gave us a lot to think about, and you also provided a nice bridge for me to hand over to Marcos.
Okay, thank you, Ilka. I'd like to thank the UN DESA for the invitation for this panel. I'll talk about some issues related to Brazil and some general issues. This is the presentation plan. 5 parts. I'll talk about simplification method used in Brazil, the transition we are having because Brazil is trying to become a full member of the OECD, so we're going to make some changes. And then I'll talk about the challenges in designing and enforcing transfer pricing in relation to financial transactions specifically, and how these challenges differ between developing countries. And in the final part, I will talk a bit about COVID impact in financial transactions in Brazil and the transfer pricing rules. Next slide, please. Until 2012, payments of loans interest under agreements duly registered in the Brazilian Central Bank were not subject to transfer pricing adjustments. So it was a sort of safe harbor, a huge safe harbor. The taxpayer only needed to register the operation, the financial operation in the central bank, and that's just okay. It did not work very well. So since 2013, we have a new regulation, new law in place, and how it works. It's still very simple, but how it works. There are 3 situations depending on the type of the loan. It only addresses loans. In case of transaction in US dollars, subject to fixed interest rate, the base is the rate of the Brazilian sovereign bonds issued in dollars, US dollars. In case of transaction in Brazilian real, Brazilian currency, subject to fixed interest rate, the basic rate is the Brazilian sovereign bonds issued in Brazilian currency in the foreign markets, so international issuing. And other cases, the basic rate is the London Interbank Offered Rate, the LIBOR, for the period of 6 months. So we have this basic interest rates, but depending on the operation, if it's a lender or a borrower, we're going to have a cap for the deduction. So you use this basic rate plus 3.5%. So have the limit for the deduction based on these numbers. If the Brazilian company is receiving the interest, so you have the minimum interest income, which is that rates on the Brazilian bonds and LIBOR, depending on the situation, plus 2.5. So it's very simple in terms of regulation, in terms of auditing and applying it to the cases, because you don't have to look for comparables in them. That's what we're talking about in the next slide. Please, next slide. Okay. These rules are mandatory. It's not an option. So it's more than a safe harbor, because the taxpayer does not have another option, another methodology. They apply not only to financial transactions between related parties. This is important in terms of BEPS approach. All the transactions between a Brazilian company and a company in a listed jurisdiction, or the tax haven, in a tax haven, it will be subject to those regulations, the same regulations. It doesn't matter if the other company is a related company or not. Other point is Brazil does not adopt the paragraph 2 of Article 9 of the model conventions, so we don't have the adjustments from there. But Brazil can discuss double tax issues through maps, but we don't have APA programs, advanced price agreements program. Brazil does not use it under the current law. So these are the remarks on that, but there are other limitations. The Brazilian law does not address hedging activities, financial guarantees. We discussed a lot about financial guarantees in the previous sections. Captive insurance also, there's no rules for that. So what happens if you have a case on this financial guarantees and insurance? We have to look at the other methods in this case, because it's not a loan, it's not an interest rate. So the CUP, resale price, or the cost plus, and with fixed margins, because Brazil adopts fixed margins. We don't have a TNMM and the profit split method in the law. Next slide, please. So what are the advantages of this approach, the Brazilian approach for interests and for loans, financial transactions as loans, international loans, and what are the disadvantages? The most important advantage is the simplification, as I said. No need for comparables. It's like the sixth method for commodities. So you look at the market and you have the basic rate. So just adjustment depends on the Brazilian company is a borrower or a lender. The ease of tax compliance and documentation, it's a pretty easy in comparison to other methodologies. Ease for tax administration, the tax auditing, it's easier. And the tax certainty from a domestic perspective. What are the disadvantages? Risk of double taxation, because you have the rate in the interest rate in the law. So if the arm's length actual rate, interest rate is they're not the same or not close to that, gonna trigger issue of double taxation. Lack of guidance in regard to cash pooling, hedging, and financial guarantees, as I said. Risk of BEPS, particularly related to actions 2, 4, and 9. But we have, Brazil has thin cap rules and CFC rules too, so it may be help a bit on that. It does not leave room to apply alternative methods. It's mandatory. And the tax uncertainty from international perspective. So in this case, we have MAP. So the risk is to increase the MAP cases. So it's how Brazil deal with the financial transactions. Next slide, please. Now about the transition. Brazil is, as I said, is applying to become a full member of the OECD. So what's at stake? It's the tax system, but the main focus now is the transfer pricing rules, because Brazil adopted a different approach to arm's length. The project began in February 2018. In 2019, the report came out. It's a huge report of 300 pages long. And about the financial transactions, what the report says, what are the guides to the transition towards the arm's length under the transfer pricing guidelines approach. Provide guidance for the application of the arm's length principle to all types of financial transactions. And I think in the future, the UN manual will be very useful for Brazil. Refine the existing thin cap rules and consider adopting BEPS action 2 and 4 recommendations to address BEPS challenges in a broader way. Consider introduction unilateral, bilateral, and multilateral APAs. It's very good if you can do that. Include a paragraph 2 of Article 9 in the treaties, and to provide for corresponding adjustments. Ensure the effectiveness of the MAP process. It also needs to adequate the capacity of the service, and consider an effective dispute resolution mechanism to resolve the transfer pricing dispute between countries. Also a matter of capacity here. And also consider whether to provide for the possibility to perform secondary adjustments, which currently we don't have to. What have been done so far? We have the pandemic may have some impact on the speed of the alignment, because turn things more difficult to deal with. But what have been done so far? There was a public consultation in 2020, ended October last year, and the focus of the consultation was having inputs from the market and the stakeholders about safe harbors. It's very important in terms of simplification. Some on comparability and APAs. So safe harbors and APAs are in the focus. What are the challenges in designing and enforcing transfer pricing in relation to financial transactions from a tax administration point of view? So have designing issues and enforcing issues. Transfer pricing for financial transactions are one of the most complex topics for transfer pricing. So we need a technical capacity to do that, to design the rules. We have political issues also because we have interest groups around the policymakers. It's how democracy works, but strong here. It's important to have a detailed secondary law framework, and also that this secondary framework, law framework, can be changed because of the volatility of the financial market. So you have to update constantly the regulations to follow up with the volatility of the instruments of the financial market. So it's important too. So it's a challenge. And in terms of design, the use of simplification rules and safe harbors, it's very important. It's in the UN manual. Some examples and some guidance on that. So it's quite important for the developing countries. In terms of enforcing the regulations, the law, it's a hard task. So capacity building is in the core of the discussion. So we always have, when it comes to developing countries, the problem or the issue of capacity building. Next slide, please. And how we talk a bit about how the financial transactions in terms of regulations and enforcing differs from developing countries. First, it's not just a matter of capacity. Capacity is a matter, of course, it's an issue, but it's not only a matter of capacity. There are differences between the financial sector, financial operations, are how they are regulated in the developed economies and developing countries. But there are also some specific issues, a lot of the developing countries that you don't find, you don't see in developed ones. For instance, exchange controls. So in the developing countries, you don't have to deal with this type of issue, but some developing countries, you're gonna have to look at it very carefully because your comparables will not be useful because there are some specific exchange controls for specific situations, specific transactions. So there are this type of difference in the structures of the markets, or how the market is regulated, because we're talking also about the exchange of currency exchange here, because we're talking about international transactions, financial transactions. So also information. The developing countries are more in line with the information access, in line with the global forum of information guidelines. So maybe the developing countries will not have too much access to information as we have in the other countries. So it's a matter of structure, but it's still a matter of capacity. It's always a matter of capacity. So having a simplification, simplification measures in the legislations is very important for developing countries. It may not be that important for developed countries. Maybe it can be, but it's not that important as it is to developing countries. So simplification measures are very important, and also capacity building for developing countries. Even though we have safe harbors or simplification measures or more training in APAs and dispute resolution methodologies, capacity building is still very important for developing countries. So that's the point. Now it's my last slide. I will talk a bit how COVID-19 pandemic have been impacted in the financial transactions as related to transfer pricing in Brazil. The first thing is about the currency. The Brazilian real suffered a strong devaluation in the pandemic. It showed 22.4% of devaluation. So it obviously impacts international laws and other contracts. But because our methodology is very simple, the current rules do not allow to reflect the change of circumstances due to the pandemic, because it's very simple. So there are no special rules to cope with the pandemic. There are only general rules, such as a negotiation of debts, tax debts, and postponing the payment of tax, and postponing the tax return filing. But they are general, not specific for transfer price. We don't have specific rules for transfer pricing in terms of coping with the pandemic crisis. But I think it should be necessary to think on that, because some aspects of transfer prices are affected and badly affected by the pandemic, even though you have even if you have, like Brazil, a simplified methodology. So we have to make adjustments because of financial transactions default, stuff like that, and currently we don't have it. So I think we need to look at it to solve some issues that will come because that will appear in the market and because of the pandemic, but we don't have it so far. So I'll close here. My time is run out, and thank you for the attention.
Thank you, Marcos. Thank you so much. I especially liked how you presented some simplification measures that were used in the past and how you're now slowly moving away from it, to show kind of that transfer pricing is, of course, also a journey for many countries. I will say one more thing, and we will have a Q&A at the end of the session, so I encourage you all to keep on asking questions in the Q&A tool. We saw that we've received some already, and we're very happy about that. But if you have specific questions or more questions, please keep on asking them. And I'll now hand over to Nishana from South Africa. Thank you, Nishana.
Hi, everyone. Pleasure to be here today. And I see that I've got some of my South African counterparts on the call. So welcome. I just wanted to do a slight correction. My work with ATAP was previous, not current. So just a small correction there, an amendment. I've got 10 minutes, and I'm going to try and pack my 10 minutes with as much information, but as I can, and I will try and be to the point. Just following up on Marcus's presentation and the points made by Richard. From a South African view, I've always been amazed that one line item of deduction can cause so much tension, and that's interest. So from a legislative point of view, we've got multiple rules. We've got tax rules, which in the Income Tax Act, which is broken down between general rules and specific rules. We have a withholding tax system. We've got a rate of 15% at the top end, but the treaty can reduce it to 0, and it depends on the trading partner. You've got your accounting standards, which I think a lot of people tend to forget. You've got IFRIC 23, which is a new standard, a relatively new standard, but where auditors will take a very hard line and a very conservative view. And if they feel that interest deductibility is at risk, you've got to make an IFRIC 23 provision or disclosure. And then you've got IFRS 9, which deals extensively with intercompany borrowings and expected credit losses, resultant expected credit losses. And then you've got other government regulations, as Marcus said, exchange control measures. So in South Africa, you have got a mandated rates of interest that you can actually pay out of the country. Next slide. So just from an income tax perspective, I feel that we suffer from, from an overload of interest limitation rules in various shapes and forms. We've got our general deduction rule, which says that interest as a whole is not deductible if it is not in the production of income and for the purpose of trade. So it's an and test. This has got nothing to do with limit. This has got to do with a very relevant point that is raised in the UN manual about where and how the capital or the borrowing is deployed. And so, if it is not deployed in a manner that is consistent with the income and trade purpose test of the Tax Act, you're just not going to get the interest deduction. And then we've got a multitude of specific rules. We've got rules that apply to all interest-bearing debt arrangements. We've got anti-avoidance rules relating to hybrid debt instruments and hybrid interest. Then we've got interest limitation rules out of reorganizations. And on the next slide, Ilka, we have got rules on related party borrowings. And then we've got the arm's length test. So South Africa previously, prior to 2012, had a debt to equity safe harbor ratio of 3:1, and with an interest rate safe harbor of prime +2 on rand denominated loans, which is our local currency, or the relevant interbank rate +2% on any foreign currency denominated loans. In 2012, that rule moved to an arm's length test, and it's a twofold test based on whether you would have and could have borrowed, and then pricing the debt in terms of an interest rate. And needless to say, that as the other discussants have referred to, is not an easy test to apply. Next slide. And now in our recent budget, that we had in the national budget disclosure, our Minister of Finance has made reference to that we will have further tax revisions regarding interest. Over the last year, our National Treasury has released documents around, targeting or amending this interest limitation rules to be more in line with the OECD guidance. And, the proposals on the table so far is that we will move to a fixed ratio rule, most likely 30% of tax EBITDA, with a 5-year carry forward and a de minimis, to exclude small to medium-sized enterprises. This is at the moment proposed, and there's going to be, from what I understand, further business consultation. Next slide. Now, from the perspective of business, and I know I've been on both sides. I've been in government, and I can understand why tax authorities view excessive debt and interest arrangements as base eroding. But from the perspective of business, and I thought that Chapter 9 does well to highlight why do companies borrow? Fundamentally, the primary business reason is that funding arrangements are there to support the value creation process of an M&E, whether it's for expansion, whether it's for investment, whether it is for sustaining the business, depending on the business model. There are some business models that, survive on overdraft and having a facility. If you are largely, a service, business model, and you have a high debtors book, your debtors are paying you anywhere from 30 to 60, and sometimes, depending on the industry, 90 days. How do you manage cash flows if you don't have an overdraft or facilities arrangement? So that depending on the business model, debt plays a very important and a very business, there's a credible business reason for that debt. Paradigm 2.2 of the new updated guidance also refers to the fact that the decision to borrow is very seldom dictated by a tax department. Most businesses, the decision to borrow is taken by a management board, and they will define how much debt the business can actually absorb and what the capital structure should be. Most companies, and if you're a large multinational or a listed company, you will have an investment committee that will make these decisions and apply their mind to the options available. So it's not necessarily that companies take on debt just to suffer or to get an interest deduction. And a 9722 of the guidance makes a very important reference, and it says that it's important to analyze the intended and actual use of the loan funding. And I find in many tax administrations, actual application of the loan becomes an afterthought, when you're doing a transfer pricing analysis, to running the arm's length test in terms of debt capacity, creditworthiness, and evaluating the interest rate. And this is an important consideration in a South African context, because as I said, you've got a general rule that says if the loan is not used in the production of income for the purpose of trade, you can deny your interest deduction at that point. You don't need to get to an arm's length transfer pricing analysis. But all of these considerations bring you to the point to say, at what point does value creation objective of a business become base erosion in the mind of a tax administration? And again, this requires, as I've mentioned, an analysis of various factors, not just the intention of the business and the rules of the country, but also understanding macroeconomic factors. What is the cost of borrowing in your domestic market? How easy is it for companies to access funding? I mean, I can tell you from a South African market, we have a very conservative lending environment. Large, multinationals will not get the requisite level of funding if they want to engage in, massive expansion or capital investment projects. We have 4 major banks in South Africa, and they are very conservative. They will tell you that themselves. Next slide. And what does COVID, we're not even in a post-COVID world. And I remember reading something in the media that says revenues are falling faster than cash is being generated. And that phrase stuck with me, that we in an environment where we may have had a 30-day lockdown period, but the effects, the economic impact of that lockdown period will be felt for months, if not years to come, depending on the industry. Let us not even talk about the tourism industry at this point. In South Africa, our official unemployment rate during the fourth quarter of 2020 rose to 32.5%. And all I can say is, and I'm not even an economist or somebody that is well versed with how countries are run, but in my very layperson view, I can almost see that we are not going to tax our way out of COVID and the impact in order to generate, revenues. We are going to have to grow our way out of this. And this is where, for policymakers to understand when you are setting, your rules, or when you are evaluating, if you're in the process of evaluating where you are around, tax legislation, around excessive debt and interest, this is something that you should be keeping a very close eye on. How is my economic and growth incentive plans tie into my tax policy? And most policymakers will tend to see these as separate, but I actually think they're quite interlinked. You cannot have tax policy that works against economic growth and foreign direct investment. Next slide. So what does that mean? Do we go with an arm's length test, or do we evaluate simplification measures? I know firsthand that many developing countries their first initial reaction is that they don't like simplification measures. And from my own time at Revenue, my hesitation was always based on how do I agree a safe harbor when I'm not fully confident, or I don't fully understand what I'm giving up. I don't even understand how much tax is being lost. How do I set the safe harbor and set it at an appropriate rate when we don't have that context? So the hesitation is always to be, is always negative against a simplification measure. But if you ask me, finance, when dealing with, financing transactions in transfer pricing, this is probably the one area where a safe harbor may be the most appropriate solution, because it may strike it's pragmatic, it's practical, it provides certainty, and it may not eradicate base erosion, but it may be that necessary balance to limit base erosion while still achieving your policy objectives of foreign direct investment and economic growth. Because the one thing taxpayers like, and I feel very strongly about that, is tax certainty. And I think many tax administrations, that is their role. Over and above tax revenue collection is to provide tax certainty. I can also, comment from a South African perspective that having too many complex rules with limited capacity, in my mind, you become a jack of all trades and a master of none. Your rules are so complex that they start to not work for you, and for many reasons. Sometimes your own in-house tax auditors don't understand the interplay of the rules. Furthermore, applying the arm's length test to debt to intergroup financing transactions. I mean, I thought that I really liked the read of the updated UN guidance. There is much information, out there, whether it's OECD, whether it's the United Nations, whether it's advisory firms, on what you need to look at. How do you perform a debt capacity analysis? How do you evaluate credit worthiness? And all of these are really great pointers. But for an auditor who is sitting behind a desk, for him, it's information overload. When banks evaluate or take the decision to lend and to set an interest rate, they look at a multitude of factors, and they have highly complex credit models and highly dedicated and focused and specialized people running these models. They look at management, they look at business models, they look at your strategic plans, they look at the industry in which the borrower is operating in. I mean, can you imagine somebody in the tourism industry now trying to go and get a bank loan in South Africa? I can tell you his chances are almost non-existent. So for any company operating in the tourism sector, right now his only hope of funding is intra-group, because banks are going to be looking very cautiously at such an industry. They look at pipeline. Banks will evaluate size of your debtors book. Now, how does an auditor sitting, who's probably never worked in a bank, who has got no banking experience, how does he evaluate all of that, bring all those factors into making a decision in his mind that on debt capacity? It's almost impossible. Credit worthiness, the same, I think the previous speakers made reference to developing countries right now, the rate of return, the interest rate of return for them would be overlaid by, some sort of country risk adjustment. And something that has always been a point of contention is how to perform a country risk adjustment. How does an auditor sitting behind a desk make an assessment around country risk adjustment? So it is highly complex. So my My only takeaway from, or my parting shot for this is that it's easy to design rules. It's far more difficult to implement them. But for tax administrations, and I wouldn't want to separate developing countries from this, because I think financing transactions and transfer pricing is actually quite complex for even the developed world, and even for countries with highly sophisticated and well-capacitated transfer pricing practices. It's not easy. Consider a safe harbor, consider a simplification measure. Start designing your rules with the end in mind. Understand your domestic environment. Understand where you are in your evolution of economic growth. And then, as Marco said, understand the capacity constraints that you may have as a tax administration to enforce such highly complex rules. And I think on that note, I will stop.
Thank you, Nishana. That was very interesting. Also talking about both simplification measures, but also the need of business to borrow and to grow. I will now turn to our last speaker, Stig Solent from Norway. Thank you, Stig. We cannot hear you, Stig. Unfortunately, we cannot hear you, Stig. All right, then let me turn to the Q&A then. So sorry, Stig. I'll ask all the panelists from the second session to turn on their camera. And we, in the previous session, we got a question on COVID-19 impact, and Nishana spoke about this, and also Marco spoke about this, but I think, I'm not sure, Richard, did you touch on COVID-19 impact? If not, I would give you the opportunity to talk about this for a little bit.
Yeah, so I'm definitely busted on that one. I did not talk about COVID-19 impact. So, I think, and it's not entirely clear to me, what COVID-19 impact would be in a particular situation. Obviously, to the extent of deteriorating financial condition of borrowers who are then in the market to obtain financing through affiliate borrowings from other affiliates, that's going to impact the credit analysis. So certainly there could be dramatic changes, both positive and negative, but perhaps more likely negative, with respect to the borrower's financial condition and the borrower's credit worthiness and ability to repay a loan. On existing intercompany loan or guarantee transactions, there could also be either a deterioration or a positive impact of COVID, depending upon the facts and circumstances. This is a tough one, quite frankly, in that, if there is a dramatic deterioration, so if business completely dries up at the borrower level, then that loan obviously becomes a workout situation for the lender. You have issues, as far as the parties are concerned, in terms of, well, what would unrelated parties do under the facts and circumstances. I also think that consistent, I think, with the OECD's approach on the impact of COVID-19 on transfer pricing, as well as I believe the UN's approach, you basically apply the existing rules as best you can to the changed facts and circumstances. So it's really an individualized case as it relates to, what unrelated parties would do with respect to an existing loan transaction or guarantee. And again, in the case of a prospective new transaction, obviously you would take your borrower and your lender where you find them.
Thanks, Richard. That's interesting. I think let me pull up some questions from about Brazil. So those would be for Marcos. They were asking about the possibility for mutual agreement procedures now under the new system. So maybe you can speak about mutual agreement procedures, especially with a focus on financial transfer pricing.
Are you talking about the question in the question and answer about the map? I think it's the focus of the question here is not only about map itself, but it's about the second part of the paragraph 2 of Article 25 of the comments on the OECD model about and it comments on about the time limits of the to implement the map case. So because Brazil have a time constraint in terms of statute of limitations, which is 5 years. So it maybe go beyond this. It's a very controversial issue. The question is a hard question. It's in the treaty, this disposition, but currently Brazil is not member of the OECD, but in the inclusive framework is adopting also this. Brazil is in the inclusive framework is also adopting this type of solution. So it depends on the case, because if the taxpayer asks for a map, but before asking for a map, he had asked or the taxpayer made a tax claim before the statute of limitation. Of course, in this case, the map case will cover all the period. But when the map case starts and the statute of limitation is applicable, so you have a problem because you have a law in Brazil, the tax code, the national tax code, that only allows for tax claims for 5 years. The time limit for the tax claim is 5 years. So you're going to have a problem here. Probably, if you have a concrete case, a real case on that, it will be up to the judicial courts to decide upon it. So it's not a very easy question to answer, because we don't have regulations on that yet. Okay, that's my point of view on that.
Thanks, Marcos. Then we have a follow-up question from South Africa, and they were speaking, or their question was related to safe harbors and simplification measures, and how useful or effective they would be in managing the impact of COVID-19 or just general times of financial crisis in pricing financial transactions. Maybe Nishana, do you want to answer?
Yeah, I think I've already made the case, especially for financing transactions, to use safe harbors. And that is all things considered, and I will say it again. The capacity shortages is not limited to just developing countries. I think it's all around, because, I mean, transfer pricing on its own is so complex. And developing countries, and I always say this, we struggle with vanilla type transfer pricing. And that is because of, you know, the length of time we've been doing it, or the number of staff that you might have in a tax administration, their depth and breadth of knowledge. So normal transfer pricing on its own presents so much complexity. When you put financial transactions into the mix, and as it was stated earlier, the UN guidance didn't even go into complex financing arrangements. It only addressed intergroup loans and guarantees. When you get into the space of, you know, derivatives and other, you know, financial instruments that have the characteristics of loans, you will struggle. And then I always think rather catch something than nothing. And a safe harbor, for all its shortcomings, might just allow you to do that.
Okay, thanks, Nishana. Does somebody else have insights on this question? Richard? No? Okay, then let's move on to one that's more focused on documentation process. One question was, it was mentioned that if no comparable loans can be found, taxpayers can turn to comparable bond transactions. Does that mean that taxpayers always need to start with searching for loans and demonstrate that no sufficient number of loans were found, and then they can turn to bond comparables?
I might be able to initially tackle this for the group. So a comparable loan transaction is more likely to be reliable, all things equal, than a market bond transaction. However, I think it's a really good point that the question raises, whether there are comparable loan transactions that are observable to serve as a benchmark. And generally, the answer to that question is no. So as a result of that, typically in the databases, by and large, like Bloomberg, S&P, ICE, they're going to look at corporate bonds because pricing for those, they tend to be publicly traded, and pricing for those is quite observable. And there's, again, in the major currencies, as I've mentioned, significant activity, so you can construct a yield curve for the particular borrower. Now, it's interesting, you know, one of the points that's made in the UN manual is that, you know, you look at realistic alternatives, and a corporate bond is a realistic alternative to a loan. The way I think about corporate bonds, because they're used so frequently to benchmark intercompany lending, is not that they're realistic alternatives to a loan. They are loans, but that they're really comparable, potentially comparable to loans. And so I kind of view corporate bonds as comparable to loans, subject to appropriate adjustments as needed to ensure that the corporate bond, you know, individual attributes is adjusted to kind of satisfy the reliability standard of comparability for purposes of benchmarking an intercompany loan.
Thanks, Richard.
I'm sorry, Richard, is that on the interest rate side?
That's right. Yes.
So it doesn't factor debt capacity.
I think that that's right. You know, I think that, you know, first you evaluate the credit worthiness of the individual borrower, right, with the assumed implicit support. So you get your credit rating of the borrower on that basis, and then you go to relevant corporate bond yields by industry, perhaps, by country. You know, there are lots of different indicative quotations on corporate bonds across different industries as well as currencies. So you would try and, I think, match up the corporate bond yield to the terms of the intercompany loan transaction while adjusting for comparability differences.
Thanks. We have one question on loans. What happens if loans are very old and tax teams can no longer provide details as to whether investments were undertaken with the loan money, or if working capital was funded and so on? And then how would you tackle this doing an audit, and how much would you allow or disallow based on such a fact pattern?
That's a great question. I could give an initial response to that. It's a really, really great question, because let's say that you have a 10-year term on a intercompany loan. You would benchmark that loan for arm's length pricing based on facts and circumstances existing as of the date of the loan transaction. So once you determine based on those facts and circumstances what an arm's length rate is, query whether if circumstances change in future years, that initial benchmark and analysis would no longer apply. My way of thinking is that once you agree for, depending on the tenor of the loan, again, if I'm using long-term tenor because the impact is really more visible here, once you determine what an arm's length rate is for a 10-year loan, query why it should be revisited at all over the remaining loan term.
Well, from personal experience, I would say that also depends on domestic legislation. I mean, some domestic legislation may ask for you to revisit loans on a yearly basis, actually.
The conditions change, so the arm's length interest rate applicable to the transaction also change. So it depends on how the law deals with that. But in the case of Brazil, it would be simple as always, because the rate, which is deemed to be the arm's length rate, is based on the bonds rates when the contract is signed. So there is no, I can say that there is no provision in the law that allow you to change this rate after it's fixed. So if it's a 5 years, 10 years loan, it does not matter. So you're gonna have in the beginning of the contract the interest based on depends on the type of loan, of course, in reals or in dollars, whatever. But you have the interest plus 3.5 or 2.5, depends on the case, and it's for the rest of the contract. And there is no provision in the law that allow you to change that. But if you are applying the general guidance in the manual of the TPG, OECD, transfer pricing guidelines, it may trigger some issues, because at some point in the contract, a long-term contract, you may have the conditions change too much that the arm's length price for the interest rate is no longer the same that it was 5, 10 years or 8 years before. So it's a real issue. If you don't have the data for that, how? And a question for the person that made the question: how did you do when you made the loan, contract the loan 10 years ago? There was some basis for that. There are some comparables you used for that. So you have to only adjust it to the new conditions, because you did not pick a rate. At that time, 10 years ago, 5 years ago, you had factors and the delineation of the transaction to be done at that time, and now you have only to adjust to the new circumstances. So if you do the right thing 10 years ago, it's easier to adjust now. That's my view on that.
All right, thank you. There's a question about guarantees, and the question is kind of aiming at distinguishing between implicit and explicit guarantees, so implicit group support versus explicit guarantees. And the question is whether if a subsidiary, if the parent is mentioned in the default clause, if that would be considered an explicit guarantee.
Well, I think.
Sorry, Richard, go ahead.
Okay, thanks. A guarantee is explicit if the guarantor is legally obligated, right, to perform under the terms of the loan instrument if the borrower is unable to perform. And so hopefully it's reasonably clear when an explicit guarantee exists or does not exist. And there are examples in perhaps in the OECD guidelines on Chapter 10 about that, a keep well or something less than an explicit guarantee is not a explicit guarantee. It may influence potentially the value of implicit support, but implicit support is much more amorphous, you could say, and difficult, or challenging to be able to quantify. And Nishana, you may want to add to that.
No, I just wanted to understand when we say the divorce clause, because generally in the agreements we see, again, implicit guarantees, for me, hard to price. I do know firsthand that the banks do factor that in their lending arrangements, and it is a consideration, but what weighting they put on that, it's uncertain. Explicit guarantees in the South African environment, it varies, but generally you would see 1% of 1 to 2% of the transaction or the loan value as being an explicit guarantee. But your point is that there has to be a legal obligation in order for there to be an explicit guarantee recognition, and I agree with that.
It's on the contract, so explicit, yeah. But and the implicit is not in the contract, so it to come up based on the analysis of the facts and circumstances of the arrangement.
Okay, thank you. We have one more question for Nishana. Nishana, what is in your review a better tool for assessing whether there is excessive interest as a result of the quantum of the loan?
What is your
view on what is a better tool for assessing whether there is excessive interest as a result of the quantum of the loan?
A tool, meaning like a safe harbor?
No, meaning how would you decide? I'm assuming that the question was asked, meaning if there's a lot of debt and virtually no equity, but you say you would have to look at the general business background and so on. So maybe you can summarize in 2 sentences how you would assess such a situation.
Wow. Well, isn't that the complexity, that it can't be summarized in 2 sentences? And it goes into a credit model. So understanding whether there's, you have excessive debt. If I just apply a very common sense approach, I would look at firstly where that funds was expended. So did it go towards a legitimate business use, or was it some sort of frivolous, like did it sit in the bank account of the borrower for months on end before it was deployed somewhere? That for me is key. And I think Monique she gave a long explanation about delineation of the transaction, understanding what has happened. And I would say this, a normal transfer pricing analysis, and I've always said it, you want to understand what the taxpayer did, when he did it, how he did it, why he did it. And the same analysis conceptually would work for a loan. So why did you borrow? How much did you borrow? Where did you spend it? Did you need it? Before you even get into complicated models, just understanding what they did with the loan funding and why they borrowed would be a good starting point.
Thank you, Nishana. We have a question for Richard. The question is, Richard, please elaborate on why you are of the view that the subsidiary's standalone credit rating is always higher than the parent company's credit rating.
Yeah, Ilka, I'm not sure whether I said that.
I'm not sure either.
Yeah, because the subsidiary's credit rating may or may not be higher than the parent company's credit rating. And more often than not, it's not higher than the parent company's credit rating. So I'm not sure how to answer that question.
Yeah, I think I agree that both are possible, that subsidiaries have worse or better credit ratings than the parent entity. There was one question asking about maps and how useful do you think maps would be for financial transactions in particular, and also for developing countries, looking at capacity of tax taxpayers and tax administration, of course.
Who do you want to send that to?
Nishana, I'll send it to you.
Okay. Oh, that's such a loaded question. The bottom line is that you try as a developing country going to map, let's just say with a developed country, and you want to argue for reduction of the debt or reduction of the interest rate and to alleviate the double taxation as a result. Any developed country will say to you on an arm's length test, if your country is high risk, if you've got volatility, if you've got certain complexities in your domestic environment, automatically would want a higher interest rate. And yes, even banks will tell you there's a ceiling where even an interest rate doesn't compensate for risk. So when you want to go to map on financial transactions as a developing country, you would have to have.
Can you hear me with this?
Solid. Sorry,
Stays back.
Yeah, you'd have to have a very strong negotiation position of all your factors if you want to alleviate the double tax. Again, the map personally, I mean, I think the stats speak for itself. Map takes too long. In developing countries, the map statistics, it's not working as great as it should be. So if you've got capacity in your audit environment, for sure your capacity in your map division is going to be even more under pressure.
That it's a matter of capacity.
Yeah. Thank you to the panelists. I think what we will do now is we will end the Q&A. Thank you everybody for the great questions. Thank you for your answers. And we're sorry if we didn't get to your question. I would now turn to Stig, and he would give the Norwegian perspective on practical problems with financial transactions, transfer pricing, and I would ask the rest of the panelists to turn off their camera.
Yeah. Can you hear me now? You can still not hear me? Yeah,
we can.
Good. Yeah. Well, what I wanted to do, since I'm on this panel mainly as one of the co-coordinators, I wanted to give a perspective on the practicability of the guidance of the manual from the perspective of the co-coordinator. We've heard very useful explanations from Marcos on the Brazilian system with their fixed margins and their specific simplified methodologies, and also the South African example. And Richard has also talked about some alternative approaches to limit excessive debt and interest costs. What I wanted to reiterate is what is the guidance in this chapter on financial transactions in the UN transfer pricing manual, because although these other approaches may be valuable, the main purpose, or even sole purpose, of the chapter on financial transactions in the UN transfer pricing manual is to give practical guidance, especially for developing countries' tax administrations, on how to apply the arm's length principle as the tool to deal with the financial transactions in intragroup. So the guidance is actually anchored in the commentary on Article 9 of the UN Model Convention, The committee of experts in that commentary spends some sentences on commenting on the value and importance of the OECD transfer pricing guidelines. But having done that, the commentary continues to say that the committee also considers it to be highly important for avoiding international double taxation of corporate profits that a common understanding prevails on how the arm's length principle should be applied, and that the two model conventions provide a common framework for preventing and resolving transfer pricing disputes where they can occur. And here is the link to the transfer pricing manual. With that aim in mind, the committee has developed the United Nations Practical Manual on Transfer Pricing of Developing Countries, which pays special attention to the experience of developing countries, reflects the realities for such countries at the relevant stages of capacity development, and seeks consistency with the guidance provided by the OECD transfer pricing guidelines. So while recognizing the importance of the OECD transfer pricing guidelines, the committee says that it is important to have a common framework when applying the arm's length principle under tax treaties, and for that purpose, the committee has developed the UN transfer pricing manual. And it is important to note, I think, that the new guidance on financial transactions, which responds to developing country requests for understandable guidance, is linked and is a continuation of the general guidance of the transfer pricing manuals, so that which also applies to intragroup financial transactions. And this means that also when dealing with financial transactions, when applying the arm's length principle, one should use the general analytical framework of the transfer pricing manual, and which how to establish relevant facts, understanding and accurately delineate the actual transactions, and applying a proper comparability analysis and transfer pricing methods, and the importance of establishing the economically significant characteristics of financial transactions. So coming from this general guidance, they can be applied to the financial transactions in question. And by doing so, approaching this under a normal comparability analysis, examining the contractual terms, applying a proper functional analysis, including the assumption and control of risks, examining the characteristics of the financial products and service, examining the economic circumstances and business strategies. So the new additional chapter on financial transactions add some specific guidance on the most frequent issues, loans and guarantees. And as has been pointed out in the first session, the guidance says looks at the transactions from both the perspective of a lender and the borrower in a loan transaction. And looking at a loan transaction from the perspective of the borrower, of course, the borrower would consider what is the best alternative when there is a need for additional capital. So not readily accept any term that is imposed in a group a transaction, but also looking at it from its specific perspective and what is the best alternative. How will I be able, according to my needs and resources, to service a loan? Looking at it from the perspective of a lender, of course, the credit worthiness of the borrower will be at the center. What is the risk in extending a loan? And depending on the ability of the borrower to service the loan and the risk of default will go into the consideration of a lender and determine the terms of a loan, including the level of interest, the interest rate. And the guidance in the new chapter has very useful guidance on how to deal with and examine and consider the credit worthiness, and this is linked to the credit rating of the group, and the issue of implicit support, because even if in an intergroup transaction situation, each entity is looked at from its as under the assumption that or the fiction that it is a separate entity and should be looked at a separate entity basis. Of course, the fact that the company is being a part of a group may influence on the credit worthiness and the credit rating of the borrowing entity. So the fact that an entity is a part of a group does not require the company to pay a remuneration for being a part of the group, but the fact that the company is part of a group can increase the credit worthiness of the entity, because depending on how important the entity is to the group for reputational aspects or otherwise, there may be an expectation, strong in some situations, not so strong in others, that in the case of a risk of a default, that other members of the group will support the entity, even if there is no legally binding guarantee present. So the implicit support or the fact that an entity is part of a group may influence the credit worthiness and reduce the interest rate for the borrower. And these considerations are discussed and set out in the new chapter. So I think that while the new guidance on financial transactions is an extension of the general guidance of the manual, here we find very useful guidance in dealing with especially loan transactions. So I think, and I also think that the 16 examples that are provided in the new chapter serve to illustrate and to further explain how the whole process of carrying out a transfer pricing analysis in this situation could be done. So the examples are not borderline cases where you can find where the limits are in different circumstances, but it gives an explanatory illustration and further guidance to explain the guidance contained in the chapter. So that is what I wanted to stress and say about the nature of the guidance. It of course also refers to simplification measures and the need and usefulness of safe harbors. But the main purpose, as I said, is to give guidance on how to apply the arm's length principle to financial transactions within a common framework established by the transfer pricing manual. And in closing, I would like to thank all the members of the subcommittee for their great work in developing this third edition of the manual, but also to the members of the subcommittee developing the first and second editions of the manual, because we do have already a very useful second edition of the manual, and Nishana and Marcos have both contributed very well to development of the current manual. So thank you so much. I'm very sorry for the difficulties with the sound previously, but I'm very happy that I was able to come in at the end. So thank you so much.
Thank you, Stig. Thank you so much for your presentation. And I will now hand over to Caroline.
Thank you so much, Ilka, and thank you to all of our panelists and participants. I want to take a quick moment to encourage everybody, please, to fill out the feedback survey so we here in DESA can learn and improve our capacity building work and ensure that it's demand driven. I believe the chat function is enabled now, so you should find there the link to the survey. It will also be sent to everybody by email as well. So if you're watching on YouTube, you'll receive the link by email. Just for really quick notes from me, the electronic version of the manual, the transfer pricing manual, will be published in April in conjunction with the final session of the current membership of the committee. We hope to have it available not only in English, but also French and Spanish. We'll be following the session of the committee, the ECOSOC special meeting on international cooperation in tax matters, which will also be broadcast, and we'll be sharing information with all participants about that. Our online course on transfer pricing is being updated in line with the third edition of the manual. We'll keep you posted on its launch in the second semester of this year. And finally, we will continue to do global and regional workshops and virtual learning, and we hope soon, eventually in-person learning events on specific issues of transfer pricing as well. So thank you so much. I would like to hand over now, please, to Michael with some closing notes as well. Thank you. Over to you, Michael.
Thank you, Caroline. I'd like to thank the panelists again and thank Ingela and Stig for today and also their leadership. I'd like to join Stig in thanking the previous as well as the current members of the Transfer Pricing Subcommittee. There's a little bit of all their DNA in the next version of the Transfer Pricing Manual, and it is a continuum. We'll have a new committee in beginning their work in July of this year, and no doubt they'll be doing something on transfer pricing. I can't preempt their program, but we hope that there will be further work on these sorts of issues, of current issues, and that the survey that you're going to provide your answers to today will actually help us in target that work as well as the capacity development work to give some direction to the membership. Finally, I'd like to thank the Secretariat. It takes a lot of people to have a short webinar. And in no particular order, I'd particularly like to thank Irving, Gabriella, Sean, Maria Fernanda, Cecilia, Josephine, Mayank, Fareed, and Ilka, who you saw both of those. And also I'd like to thank Caroline and Naveed for their support for the transfer pricing work. So with that, I'd like to thank you for participating, and until we have the next transfer pricing event, goodbye from us. Thank you.
Thank you. Bye.
Goodbye. Thank you.
Stay well. Be safe.
Be safe.
Ciao.